Good afternoon. Thank the panel, Secretary Glover and Chairman Breeden, Chairman Graham, for being here. Chairman Greenspan, when we changed the time, I ran into initially at least an irreconcilable conflict, and will join us a little later, and we've discussed that with him, and he is perfectly willing to join up with us a bit later. Over the past several weeks, there have been recurrent newspaper reports describing the jurisdictional tugging by two agencies, the SEC and the CFTC, over which will oversee regulation of stock futures. The political gamemanship makes for a very interesting copy, and it makes it very easy for someone writing the articles, but it unfortunately overshadows the much larger and more important issue, cleaning up and restoring confidence in the financial markets. In the past 2 years, we've seen a sting operation raise allegations of widespread fraud in the trading pits, a government accounting office report criticizing audit trail systems, and a soybean emergency exploding in July. We've seen the indictment of 48 Chicago floor traders, and our former colleague, Senator Tom Eagleton of Missouri, quitting the Chicago Mercantile Exchange Board to protest insider domination of exchange affairs. There's no question. The system needs fixing. Rules have been ignored, and customers have been left unprotected. And without the public's trust, futures markets can't function. They can't serve the needs of our country. It is for these reasons that last November, this committee unanimously, and I underline unanimously, passed the toughest futures reform package in decades. This legislation, S. 1729, the Futures Trading Practices Act of 1989, now awaits action on the Senate floor, and it's being held hostage by the interagency struggle. And the struggle has left market users in limbo. Many feel that jurisdictional tampering only promises weakened regulation, damaged competitiveness, and regulatory chaos. I've heard Mr. Breeden speak before that the current jurisdictional split between the SEC and the CFTC has created problems in the area of margin, innovation, or law enforcement. If so, then this committee should consider responsible, appropriate solutions, possibly even the ultimate merger of the SEC and the CFTC if this is shown to be justified and feasible. But we must also remember that radical surgery can have radical side effects. The cure can sometimes be a lot worse than the disease. And I'm concerned that stripping the CFTC of jurisdiction piece by piece will weaken regulation across the board. It could cripple the CFTC's effectiveness. It could hand over stock index futures to an agency that does not now have a program or staff in place to police them. It could create years of uncertainty and costly litigation in the process. But more important, I am concerned that now, almost 16 months since the disclosure of the FBI Chicago sting operation, and with the resulting criminal trials opening this week in Chicago courtrooms, Congress remains blocked from enacting the tough reforms we all agree that are needed. 7 weeks ago, Senator Lugar and I wrote to Secretary Brady asking his support to move S. 1729, the Futures Reform Bill, to the Senate floor separately from any issue of jurisdiction. Now, the reason we did this is because Secretary Brady previously had given the same type of green light to S. 648, the stock market reform bill reported by the Senate Banking Committee. And Senator Lugar and I did this because we felt that the Futures Reform Bill should be treated in the same manner as the stock market reform bill. The integrity of the crude oil, currency, treasury bond, agriculture, and metals futures markets is just as important as integrity on Wall Street. Now, about 1 hour ago, and for me about 5 minutes ago, I finally heard back from Secretary Brady, who now wants to use S. 1729 to shift jurisdiction from the CFTC to the SEC. This will have the most radical side effect of all: the sentencing of the Futures Reform Bill to a state of legislative limbo, complete with parliamentary holds and filibusters. It's a nice letter. It guarantees nothing will be done. Now, I'm sensitive to the issue raised by the SEC and Treasury and the arguments on both sides. But we already have a consensus as to what needs to be done to clean up the futures industry. Let's not slow that down while we study and debate the highly complex and divisive issue of jurisdiction, something that could keep us all happily engaged well until after the Congress adjourns for the year. We all need to work together on this. Fighting and pressing media hot buttons will only make this difficult issue tougher to resolve. Now, I read Chairman Breeden's statement in Saturday's New York Times that there were, quote, disturbing parallels, close quote, between the debate over stock index futures jurisdiction and the savings and loan crisis. Now, in Vermont, we tend to use our words carefully, and I was somewhat frankly startled by this escalation of rhetoric, and I thought maybe, because as a Vermonter I might not understand the different type of language used down here in the big city. If Chairman Breeden has evidence that anyone in Chicago is pilfering funds at levels of $200 to $300 billion that may have to be repaid from taxpayers' pockets, then I hope he has relayed this information to the FBI, because that would be the disturbing parallel with the savings and loans crisis. The comparison between interest groups opposed to jurisdictional changes, these interest groups which happen to include virtually all farm producer organizations, with fraudulent thrift operators, that's perplexing. I'm not really able, in my experience, to compare these farm producer organizations with the fraudulent thrift operators. In fact, I might say, Chairman Breeden, if you have evidence of such massive fraud, then bring it forward. And if not, try to relate your rhetoric to the facts, because in government that's not a luxury, it's a duty. The SEC's own record in the savings and loan affair is not quite spotless. I put in the record an article from the April 16, 1990 issue of Barron's entitled, "What Investors Never Knew," which recites the SEC's failure to warn customers about known risks associated with Mr. Charles Keating. So for today's hearing, let's keep the hot rhetoric in our briefcases. We have serious work to do. And talking about the savings and loan crises or regulatory imperialism isn't very helpful to the problem at hand. Now, we have a distinguished panel of witnesses. We look forward to the testimony from all four of you. Before we begin, I would put in the record 3 letters we have received on this issue. One from Susan Bryant, the president of the National Association of State Securities Commissioners, urging quick enactment of S. 1729 without amendment. One from the American Farm Bureau Federation opposing shifts in jurisdiction away from the CFTC. And one from Robert McKay, Virginia Polytechnic Institute, on how academic research fails to show a relationship between margin levels and volatility. I yield to the distinguished senator from Indiana.
Thank you very much, Mr. Chairman. The importance of this hearing cannot be overemphasized, and I commend you for assembling this distinguished panel. Legislation to provide much-needed regulatory reform in the futures markets has languished for more than 6 months as a result of interagency dispute over which agency should have jurisdiction to regulate certain aspects of futures trading. I believe it's critical we resolve the current dispute in order to move forward with the needed reform provided in S. 1729. The first trials resulting from the Chicago sting operation began yesterday. However, our efforts to provide new regulatory tools to enhance that trade surveillance and monitoring activities remain on hold. As we can conclude from press accounts of this interagency battle, the actions are spirited. Some journals liken the current dispute to a hostile takeover. Last week, as you've mentioned, Mr. Chairman, SEC Chairman Richard Breeden claimed there was a close analogy between this issue and the savings and loan crisis. And perhaps this hearing will illuminate evidence to substantiate those allegations. Previously, accusations of, quote, regulatory imperialism, end of quote, have been levied by those of a different view. It seems to me that an inordinate amount of time has been spent trying to persuade the press that one position is more correct than another. And in the midst of this dispute, 2 important reform bills, one for the SEC and one for the CFTC, remain in limbo. Proposals on jurisdiction run the gamut, from no action to a wholesale merging of what are now 2 independent agencies. At this point, I do not find the evidence compelling with regard to any of these proposals. I do question, however, the wisdom in taking any action as an intermediate measure. If a problem exists with regard to regulatory authority, then a comprehensive solution should be fashioned. This committee has attempted to address all situations in a comprehensive manner, and this issue should not be treated any differently. Mr. Chairman, I know that, or rather I hope that the information we receive in this hearing will enable this committee to deal with the current jurisdictional issue and then hopefully to move swiftly to the floor to pass futures reform legislation. Thank you, Mr. Chairman.
Thank you. And I would note for colleagues, I'm ready to enter into a restricted and short time agreement at any point to move the CFTC reform bill. I think it is the toughest one I have seen in my 16 years here in the Senate, and I have told the Majority Leader and others I am perfectly willing to go forward at any time under as short a time agreement as can be entered into. Does anybody else wish to say anything before we start with our witnesses? Senator Gordon.
Mr. Chairman, as the author of the amendment which is pending in the Senate to the CFTC authorization bill, and as an obvious minority on this committee, though I suspect not on the floor of the Senate, I believe it's appropriate to make a few opening remarks. The amendment on the floor of the Senate is not the result of a jurisdictional squabble between the Commodity Futures Trading Commission and the SEC. That amendment was placed on the floor by this senator with a view toward the proposition that it represented a vitally important, though completely unaddressed, subject in connection with last year's CFTC hearings, one which was simply not addressed in any of the hearings on that subject. I began my examination of the CFTC without any opinions one way or another on the subject. I have been led increasingly, and I think inevitably, to the position that without the slightest degree of criticism of either of those regulatory agencies, that an inherent instability was present in American markets by reason of a divided authority over two kinds of securities, commodities, whatever we wish to call them, which were so closely and carefully intertwined. During a period of time during which I was not in the Senate, now Secretary Brady examined very carefully and very thoroughly the causes of the stock market crash of October 1987. In addition to the additional drop of about a week after that, there have been two significant drops since that period of time. I despair, in a sense, of dealing with this proposition, perhaps until another such crash has taken place, or perhaps one after that. It's at the point at which the Congress will be willing to deal with this question. This CFTC reauthorization bill has not, I repeat, not been blocked by the proponents of this amendment. I was willing in November and remain willing at any time to enter into a time agreement under which it is debated on the floor of the Senate and voted on one way or another. It seems to me that we are dealing with an important enough issue so that the Senate and the House of Representatives should be willing to debate it. The administration has now taken a firm and strong position on the subject. We have in front of us 4 witnesses. I must say, without deprecating them to any degree at all, in a sense I'm a little frustrated at this late date at the narrowness of the testimony we're receiving. 2 of our witnesses have an obvious institutional bias in favor of one position or another. They have the 2 institutions which are affected by the amendment. The others are more neutral members of the administration and of an independent agency. I had hoped, I asked last year, and I continue to ask, that we might have some outside academic experts on the subject speak to a subject which is highly complex in nature, the precise answer to which I'm not sure is held by any member of Congress. But the obvious desirability, it seems to this senator, of coordinating, of seeing to it that a single agency provides consistent regulations with respect to two so important a set of impacts on capital formation and the future of the financial system of the United States seems to me to have become more obvious rather than less obvious during the course of the 6 months debate on this subject. I simply repeat that it seems to me that it is time that the subject was debated, and I would urge the chairman and ranking members of this committee to see to it that it is debated on the floor of the United States Senate. If someone intends to filibuster the bill, let's find out who those filibusterers are. Otherwise, let's vote on something which is very important. Let each member of the Senate determine whether or not he or she wishes to continue a system which has at least been coincidental with 4 very, very serious drops in our stock market in the course of less than a 3-year period of time, and wishes to do so in the future. I think from the point of view of this committee, which after all is primarily the Agriculture Committee, we would have a stronger and not a weaker CFTC if it were required to spend more of its time on the agricultural and other commodities it was designed to regulate in the first place than it does with the tail wagging the dog, and with so much of its attention being focused on something that wasn't even invented or thought of at the time at which the CFTC was originally created. I'm happy that we're having this hearing, Mr. Chairman, but a hearing doesn't decide the question. Only senators voting on the question can and will do that.
Secretary Glover.
Thank you very much. Mr. Chairman, I have a somewhat longer statement. With your permission, I'd like to read excerpts and have the entire statement contained in the record.
It will be. Please go ahead.
Thank you. Mr. Chairman, Senator Lugar, members of the committee, thank you for this opportunity to discuss the administration's views on regulatory fragmentation and related issues in the securities and futures markets. We believe the time has come to reform the disjointed regulation of the markets governing stocks, stock options, and stock index futures. We also believe that if steps are not taken to correct the problem now, we are more likely to see minor events trigger major market disruptions, like the breaks in October of 1987 and October of 1989. And the appropriate regulatory tools will not be in place to help contain the risk to this country's financial system. Finally, a failure to act will impede innovation, drive new financial instruments to overseas markets, and thwart enforcement of intermarket abuses. Secretary Brady has said many times, any reform must be based upon the fact that the markets for stocks, stock options, and stock index futures are really one market. The financial community already recognizes this fact, as do regulators in other countries. The question is whether our regulatory structure needs change in order to recognize this fact as well, whether one market requires one regulator, and whether this will result in progress on key intermarket issues that will reduce the likelihood and risk of major market disruptions. We believe the answer to all these questions is yes. As a result, the administration will submit proposed legislation this week. Before outlining this proposal, however, let me explain why the administration has come to this position. As the committee knows, stock index futures began trading on futures exchanges less than 10 years ago. These instruments have proved to be one of our financial system's most innovative new developments, and we believe their use has helped keep our cost of capital lower than it otherwise would be. Nevertheless, the interaction of these new instruments with stocks and stock options has been an important contributor to major market disruptions, periods when the markets disconnect with prices spiraling down. These major market disruptions are not episodes of markets adjusting to fundamental changes in value or responding to major news events. They are periods when the markets break down, as history has shown us. In the 52 years between 1930 and 1982, the year stock index futures began trading, the Dow Jones Industrial Average declined by more than 6% on only 3 occasions. When the Germans took the Netherlands in May of 1940, when they encircled the Allied forces at Dunkirk just days later in the same month, and when President Eisenhower suffered a heart attack in September of 1955. By contrast, as the future markets have grown, such massive one-day sell-offs have occurred 4 times in the last 3 years. but not one of these days corresponded with any major news event like the ones before 1982. Instead, they all shared the characteristic of enormous selling pressure on the stock index futures markets. We believe the problem is not an increase in average price volatility, because we have consistently recognized that there is no compelling evidence that average stock market volatility has increased over the past 25 years. Instead, the problem is infrequent episodes of violent disruptions when the markets cease to function correctly. During these episodes, pricing relationships between stocks and futures break down. Markets and particular instruments experience difficulties in staying open, and serious supply-demand imbalances develop. And very large market moves occur in the absence of underlying fundamental information. It is the increased potential for and consequences of these major market disruptions that lead us to urge prompt regulatory reform. The most disturbing consequence is the risk these major market disruptions pose to the entire financial system, especially through the clearance and settlement process. For example, after the October 1987 break, the clearance and settlement system fell over 6 hours behind its normal payment times, with futures clearinghouses owing over $1.5 billion to investment houses. Had these funds been missing for any significantly longer time, it would have unleashed a chain reaction of events where other payments to other creditors would not have been made. The Presidential Task Force concluded that the prospects of clearinghouse failures created, quote, a crisis of confidence that raised the specter of full-scale financial system breakdown, unquote. Obviously, we must take appropriate action to reduce this very real risk of systemic breakdown. Moreover, we need to address another consequence of these major market disruptions, their contribution to the erosion of investor confidence in capital formation. To bring investors back into our markets to stay, we must renew their confidence that the market mechanisms are operating efficiently and that they are still a safe place to invest. We believe the fundamental impediment to reducing the likelihood of major market disruptions and its consequences to the system and to investors is regulatory fragmentation. One regulator for the one market would have much more flexibility to to coordinate the key intermarket mechanisms that disconnect, create, or exacerbate major market disruptions. These include the following. First, clearance and settlement. I've already described the systemic risks posed by potential breakdowns in our fragmented clearance and settlement systems. While legislation is pending in both the Senate and the House to help address these systems, there is little doubt that a single regulator could help accelerate the coordination process. The second market mechanism is unharmonized margins. While there is federal oversight of margins in the stock and stock options markets, there is virtually none in the stock index futures markets. The result is a tremendous disparity among margins levels in the three markets, with futures margins often dipping to dangerously low levels. The fact is that futures traders can control so great an amount of stock with so little of their own money that relatively small amounts of capital can concentrate enormous selling pressure on the stock market, great enough to cause a major market disruption that could punch a hole in the fabric of the financial system. However, since these margins are set by the futures industry with no day-to-day regulatory oversight, there is no way to harmonize margins between futures and stocks to protect the public. This exposure to systemic risk requires federal oversight of margin setting for stock index futures, and the oversight should come from one regulator that can ensure harmonized margins among linked markets. Finally, we must deal with uncoordinated circuit breakers. Some progress has been made to coordinate circuit breakers in stock and stock index futures markets, and discussions are continuing within the President's Working Group on financial markets. Nevertheless, more can be done, and fundamental disagreements continue to exist between markets and their regulators over the appropriate kinds of circuit breakers. In short, fragmented regulation has impeded progress on the coordination of these fundamental intermarket mechanisms. We believe one regulator with appropriate authority could accelerate progress substantially towards the harmonized regulation we need to address the problem of major market disruptions. Let me now say a word about the fact that regulatory fragmentation is creating a serious impediment to innovation. This was not always true. In the past, fragmented regulation sometimes promoted innovation. But regulatory...
Sometimes promoted?
Absolutely.
Yeah, I know, I just didn't hear what you said.
Excuse me. Fragmented regulation sometimes promoted innovation. But regulatory competition has also caused jurisdictional struggles that stifle innovation. The result has been protracted litigation over what constitutes a future, an inability to trade in the U.S. markets most suited to the product, and the shifting of business to more hospitable overseas markets. This is precisely what happened to index participation certificates, which now trade in Toronto rather than in the United States. My point is this. With the globalization of financial markets, other countries have provided us all the regulatory competition we need. We can no longer afford jurisdictional conflicts that stifle innovation at home and drive important business overseas. Finally, let me mention two other problems created by regulatory fragmentation. The first is ineffective intermarket enforcement. With two different regulators, it becomes extremely difficult to prevent manipulation and fraud in transactions between the stock and futures markets. The situation is similar to state troopers who are forced to stop at the state line when chasing lawbreakers. In particular, it is extremely difficult to detect intermarket front-running, where a trader trades ahead of his client in one market, knowing that the client's trade will drive a linked market in a particular direction. We believe that integrated regulation would enhance surveillance, facilitate intermarket rulemaking, and promote accountability. The final problem involves the clear trend towards globalization of financial markets. We've already discussed how overseas competition requires the United States to take steps necessary to foster domestic innovation. But it also requires viewing interrelated domestic markets in a global context and speaking with one voice to our foreign counterparts. Indeed, every other country with major trading in stocks and stock index futures has a single regulator to make sure its financial system as a whole is protected. The SEC regulates stocks and stock options, while the CFTC regulates stock index futures. That situation should be corrected. Let me turn now to our recommended solution. This does not need to be complicated because we do not need more regulation, but we do need more unified regulation as the umbrella under which specific intermarket issues can be much more easily resolved. The result will be more streamlined and efficient regulation. This could involve the more substantial action of merging the SEC and the CFTC, as some members of Congress have suggested. Another approach would shift the regulation of all financial futures from the CFTC to the SEC. However, both of these proposals involve major regulatory changes that are more than is necessary to address the problems we believe require immediate correction. Instead, the admission supports a less sweeping approach that would only unify regulation of the one market of stocks, stock options, and stock index futures under the SEC, the agency with the greatest expertise in the combination of these products. The proposal the administration will submit will do the following. Shift regulatory authority from stock index futures to the SEC, but in a manner that minimizes the disruption to the current operation of the markets in these instruments. Second, provide the SEC with oversight authority over the futures exchange's ability to set margins, which would be similar to its current oversight authority over margin setting by the options exchanges. There would be no preset minimum margins established by statute. Third, modify the exclusivity clause of the Commodity Exchange Act in order to remove barriers to innovation that are driving new products to foreign markets. Fourth, enhance enforcement authority, especially on an intermarket basis. Fifth, provide an appropriate transition. And sixth, mandate reports within 18 months on any additional modifications that are necessary for efficient regulation of the one market of stocks, stock options, and stock index futures. The administration believes that this is the most appropriate approach for addressing regulatory fragmentation with the least disturbance to and best protection for the futures markets. Moreover, it would have no effect on the agricultural community, since stock index futures have no relation to agricultural products or agricultural futures. The proposal would also minimize the effect on the CFTC, because stock index futures represent less than 10% of the futures volume under CFTC jurisdiction. Indeed, the CFTC will be able to concentrate its considerable expertise on the more traditional agricultural and financial futures products that have long been the core of its jurisdiction. In conclusion, the benefits of unified regulation are substantial. While we embrace this approach, I want to emphasize our belief that today's problems do not come from the regulators themselves. Both the CFTC and the SEC are doing a good job under difficult circumstances, administering a scheme of regulation that simply is not designed for the unified marketplace they are expected to regulate. We believe the answer is a coherent regulatory structure that can deal effectively with unified markets. Resolving regulatory fragmentation will reduce systemic risk and promote investor confidence, which are keys to our long-term competitiveness. Moreover, led by Chairman Graham, we believe the CFTC will continue its outstanding job of ensuring the integrity and safety and soundness of the markets it regulates. We urge the Senate to speedily confirm Chairman Graham for another term so that the CFTC will have the leadership necessary to address these matters successfully. Mr. Chairman, that concludes my testimony. I'll be happy to answer questions when my time
Chairman
comes.
Breeden, we're delighted to have you here, and please go ahead, sir.
Thank you, Chairman Leahy and Senator Lugar, members of the committee. Thank you for inviting me to testify on the subject of intermarket regulation. The critical issue before us is how we can best preserve the health and well-being of our nation's securities and futures markets.
Are you following your testimony that you gave us?
Oh, no, sir. With permission, I will submit that for the record, and I have a shorter oral statement that I would deliver.
It would be really helpful if the witnesses might go to somewhat shorter. They have very lengthy statements, which are very helpful to us. But if you go to a shorter one, that we have so many questions that we'd like to ask in the time available.
Do you have a copy of it? Does the witness have a copy?
I'd be happy to provide you with one. If I give you the one I'm about to read, I will be left without one. Yeah. I'm sure we can...
You have a copy of the long one. You do have a copy of the long one.
I have a copy of the long one, but...
Go ahead, Mr. Breeden.
The critical issue before us is how we can best preserve the health and well-being of our nation's securities and futures markets. The answers that we reach will have profound implications for these markets, as well as for the strength and competitiveness of the U.S. economy as a whole. As you know, and as Secretary Glauber has just described, Treasury Secretary Nicholas Brady strongly believes that the current system of fragmented regulation of stocks, options on stocks, and stock index futures undermines the stability and competitiveness of U.S. capital markets, and the reform of the regulatory structure is urgently needed. I share his very strong concerns regarding this matter. The Commission intends to support prompt enactment of the President's proposed legislation that Undersecretary Glauber has just described. The Commission believes that the present regulatory system is seriously flawed and that the result is unnecessary risk for the markets and unjustifiable barriers to competition. The present fragmented regulatory structure causes numerous problems, many of which are described in the Commission's testimony and that of the Treasury Department. Therefore, I'll only touch briefly on those issues. First, the division of jurisdiction between the SEC and the CFTC has interfered with the ability of U.S. financial markets to compete with their global counterparts. Because of the exclusivity provision of the Commodity Exchange Act, useful products cannot trade on the U.S. markets, and U.S. corporations lose valuable flexibility in structuring financings at the lowest possible cost. In essence, the exclusivity clause amounts to a legislative grant of monopoly trading privileges. All monopolies produce inefficiency, and this one is no exception. Sadly, the expenditure of millions of dollars in legal fees and years of delay in bringing new products to market is necessary only in the United States. Other major markets do not exalt the proper regulatory classification of products over their economic usefulness. British Petroleum, Olivetti, Hitachi, Hyundai, Westpac, Volvo, Hong Kong Telecom, and other companies around the world can issue hybrid securities in markets outside the United States without having to pay the costs of litigating over the exclusivity of commodities regulation. The exclusivity clause is, in our view, a self-inflicted wound on the cost of capital in the United States, an anchor that only American companies have to drag through the water. Over time, this law will do enormous damage to both the vitality of our securities markets and the strength of the broader U.S. economy. The fragmentation of regulatory authority has also resulted in a system in which margins on stock and options are subject to federal oversight, but margins on stock index futures are not. As a result, the futures exchanges have at times set stock index futures margins at extremely low levels. During normal market conditions, this may not create a significant problem. But when market conditions become extreme, these low margin requirements can create enormous risks. When the market is in trouble, the stock index futures markets can resemble a flash flood following a desert thunderstorm due to these margin practices. This situation creates unnecessary risks to the stability of the overall U.S. financial system. The risks of low margin extend far beyond the futures markets into the stock markets and the American economy generally. Virtually every U.S. citizen would be impacted if there were a significant interruption of the national clearance and settlement system, which in the aggregate, including all of our markets, processes trillions of dollars in transactions every day. To date, we have had 2 examples of a serious weakness in the existing system. The potential impact of decisions to keep stock index future margins at extremely low levels is sufficiently great that leaving the role of protecting the public interest, the prudential interest, solely to the private futures exchanges without any federal oversight is not justifiable. In my view, the issue is not whether our current system is all right during a bright sunny day. Rather, the question is our current ship strong enough to remain afloat in a storm? The fragmented regulatory structure also makes it much more difficult to detect and deter intermarket fraud. Under the present regime, neither the SEC nor the CFTC has full power to address intermarket front-running and manipulation, because neither agency has a complete picture of what is going on in the other market. We can and do cooperate in investigations, and both agencies work hard to control fraud under the current system. But the structure itself makes it more difficult for either agency to know where and when to investigate. The 3-point program that the administration has proposed and that we support would help us solve or significantly reduce these problems. It would benefit both the securities and the futures markets, and it would certainly benefit the American public. However, a number of myths have been put forward during the course of this debate. Operate in investigations, and both agencies work hard to control fraud under the current system. But the structure itself makes it more difficult for either agency to know where and when to investigate. The 3-point program that the administration has proposed and that we support would help us solve or significantly reduce these problems. It would benefit both the securities and the futures markets, and it would certainly benefit the American public. However, a number of myths have been put forward during the course of this debate, which I'd like to briefly address. First, it has been alleged that the SEC is anti-competitive and anti-innovative. Nothing could be further from the truth. Under the SEC's oversight, a vast array of innovative and inventive new securities have been developed over the years. Some of the securities products that have been introduced during the past decade include the following, and my full testimony has a longer list, but it includes mortgage-backed securities and asset-backed securities of every type, bond index-linked securities, adjustable rate preferred stocks, reverse principal exchange rate linked securities, variable duration notes, money market preferred shares, master limited partnership units, perpetual debt instruments. Literally hundreds of these products, raising hundreds of billions of dollars, have been issued and traded as securities. Indeed, probably the most innovative and economically productive financial development in the markets over the last decade has been the entire process of securitization of financial assets of every type.
Are junk bonds in that same list?
Those certain high-yield securities of various types would certainly be among the types of securities that could come to the market under our oversight. Yes, sir.
Just out of check. Go ahead.
This, although in testimony before the Senate Banking Committee, I made a commitment to Senator Graham that I would never refer to them as junk bonds. I would always refer to them as high-yield securities, and so if you'll allow me to at least follow my agreement.
As long as we both understand what we're talking about, and I rather suspect we do.
This process has occurred under securities jurisdiction. Securities products trade publicly and privately on exchanges and over the counter virtually in any way the market finds useful. In contrast, futures contracts can only trade in only one government-mandated way, on a designated contract market. As a result, the Chicago Mercantile Exchange today actively trades about 30 to 40 different types of futures contracts, while there are literally thousands of different securities products available to investors. Another canard that has surfaced during the jurisdictional debate is the notion that the administration's proposal would seriously damage the futures markets. Market participants, in my judgment, will gravitate to markets that provide the strongest and most stable trading environment. The proposed changes should make both securities and futures markets stronger, and they should make stock index futures more attractive to many investors who are currently prohibited from participating or are unwilling to participate in the futures markets. Similarly, there is little reason to fear that establishing a system of federal oversight with respect to stock index futures margins would drive trading in those instruments abroad. I would point out that speculative margins on stock index futures were raised to 16% after the October '87 market break, during the time while margins were maintained at higher levels before being slashed to roughly their '87 levels. Not a single foreign futures market even began trading a future on a U.S. stock index. Proponents of the current system have also argued that transfer of stock index futures to the SEC would weaken the CFTC substantially and interfere with its ability to regulate the futures markets for agricultural commodities and other types of financial instruments. Frankly, the Commission does not understand how that would happen. Stock index futures make up only about 5% of all futures trading. Indeed, last year alone, 250 million futures contracts not involving stock index futures were traded. Thus, moving jurisdiction over stock index futures to the SEC should not have any impact on most of the CFTC's current oversight responsibilities. In fact, such a shift might even be positive in allowing the CFTC to concentrate its resources and expertise on the markets for agricultural and physical commodities that it was established to regulate, as well as the interest rate and foreign currency futures that are the overwhelmingly dominant products of the futures exchanges today. Finally, it has been suggested that the debate over the administration's proposal is nothing more than a turf war. That suggestion also is simply not the case. The SEC supports the proposals of the administration because we believe that both the securities and the futures markets would be better off if the stability and competitiveness of our system were improved. In our view, the important question is not whether the proposals at issue would benefit or harm the SEC or the CFTC staff, but how we can best serve the interests of the American public in a strong and vigorously competitive market. The fragmentation of regulatory responsibility over the equities markets has had serious consequences for those markets. As a result, the Commission believes that it is imperative for Congress to act swiftly to reform the regulatory system for stocks, stock options, and stock index futures in accordance with the plan described above. If we cannot agree to take effective action against these problems, opportunities to reduce the cost of capital for issuers of securities will be lost to the detriment of prospects for a strong economy. The financial industry in which the United States is strongly competitive globally will face serious long-term damage. Significant systemic risks that are completely avoidable will continue, with the potential of serious cost and damage to our economy over the long term. Thank you very much.
Thank you very much, Chairman Breeden. I appreciate your testimony and willingness to be here. Chairman Graham, look forward to hearing from you. Dr. Graham is yours.
Thank you. Mr. Chairman, Senators, I welcome the opportunity to appear before this committee to present the views of the Commodity Futures Trading Commission on financial regulation and jurisdictional issues. Our job as policymakers is to ensure fair and open markets, financial integrity, investor confidence, and international competitiveness for all U.S. financial markets, including securities and futures. The issue before us today is the type of regulatory structure that best can accomplish these goals. In recent months, several proposals...
Mr. Chairman, may I ask this witness, too, if there's any sense in my trying to follow her testimony?
You have a 40-page testimony. I do have some copies of my shorter version.
You have copies of it?
Yes.
Could we, well, tell the staff to bring them over here before they...
40-page one, like some of my very long questions, will also be part of the record.
I'm sure you don't want to hear me read the 40 pages.
Oh, I'd enjoy it, but I have a feeling that Chairman Greenspan would probably never again accept any invitation from me to anything. And I wouldn't blame him. Go ahead, Dr.
This one's
Graham.
much shorter. In recent months, several proposals have surfaced to redraw the jurisdictional lines between the Commodity Futures Trading Commission and the Securities and Exchange Commission. 3 alternatives have been proposed. Shift stock index futures jurisdiction from the CFTC to the SEC, shift jurisdiction over all financial futures to the SEC, or merge the 2 agencies. These proposals represent a radical restructuring of our jurisdiction. The reasons given in support of any jurisdictional change do not withstand objective scrutiny. The CFTC is concerned that the proposed changes would damage the world leadership position of the U.S. futures markets and would not enhance the position of our capital markets. The Commission is therefore vigorously opposed to each of these jurisdictional proposals. Furthermore, the Commission is concerned that our reauthorization legislation, which includes needed market reforms, is being held up in the Senate because of this continuing and unnecessary jurisdictional battle. To be sure, our securities and futures markets face important issues: the long-term decline in retail securities brokerage business, infrequent episodes of abrupt stock market declines, and intermarket issues like systemic risk in clearing, settlement, and payments. However, these issues do not exist because of the current regulatory boundaries or because there are two regulators, nor will a change in jurisdiction resolve them. In fact, any type of quick fix regulatory shift will only raise false hopes, increase regulatory complexity, raise capital costs, and diminish the liquidity, efficiency, and competitiveness of U.S. futures markets. Are there any credible arguments for shifting CFTC jurisdiction to the SEC or for merging the two agencies? My prepared statement includes a point-by-point analysis of the so-called problems that have been put forth, but let me touch on a few issues now. We are told that the securities market and the stock index futures market constitute one market. That is no surprise to the CFTC. All futures markets are linked to their underlying cash market. That does not mean, however, that these linked markets must be subject to a single regulator or with a single rule book. In fact, merging the cash market regulator, which tends to favor stable or higher prices, with a futures regulator, which must remain price neutral, would institutionalize the very kind of regulatory conflict of interest that Congress sought to avoid in creating an independent CFTC back in 1974. As for margins and volatility, economists have searched for but not found a systematic relationship between futures margins and stock market volatility. Chairman Greenspan's testimony on March 29th summarized the results of this research. Quote, all the analytical tools we have brought to bear have failed to find any such relationship. Efforts to restrain volatility by imposing more restrictions on particular markets or instruments could have unintended effects resulting in significant costs on the system and a shifting of transactions activity offshore. Close quote. We are also told that because margins between stock and futures are not harmonized, highly leveraged futures traders are forced to sell to meet margin calls, causing liquidity to vanish. There is no supporting evidence that the stock index futures market is more highly leveraged than the stock market. A cash portfolio position hedged with a futures position is not leveraged regardless of the level of futures margins. Moreover, the stock index futures market is used predominantly by institutions to hedge their cash market portfolios. The argument suggests further that highly leveraged futures traders must close their positions on volatile days to meet margin calls, prompting a decline in open interest for the futures contract as a whole, and particularly for the affected group. An examination of the magnitude of open interest in the S&P 500 stock index futures contract on high volatility days contradicts that supposition that a margin call sell-off exacerbated the market decline. On October 19, 1987, for example, also on October 13th and 16th of 1989, open interest at the day's end was higher than on the previous day. Another current argument is that separate regulation of securities and stock index futures encourages intermarket front-running and other intermarket trading abuses. While front-running is possible, it's not encouraged by separate regulators, nor does it go undetected because there are two regulators. The fact is that both securities exchanges and futures exchanges have recognized the problem of intermarket front-running and have recently developed cooperative surveillance techniques to detect it. At this point, there's no concrete evidence that intermarket front-running has posed a significant threat to market integrity. Both the CFTC and the exchanges are working to deter and detect any problem, and I believe that this can be accomplished within the existing regulatory structure. As to the argument that two regulatory agencies hinder the U.S. in international negotiations, I would again respond that the evidence speaks for itself. To my knowledge, neither the SEC nor the CFTC has been impeded in its dealings with foreign regulatory authorities because of our separate jurisdictions. Furthermore, there is no uniformity of regulatory structure among foreign regulators. A careful examination reveals wide disparities of regulatory approaches. Our markets have prospered under the current regulatory structure and see Therefore, we see no reason to change our system to parallel systems of less experienced foreign authorities. Finally, I must say that the most surprising argument now being made is that the CFTC and the futures industry stifle innovation, in particular index participation products, or IPs as they are commonly called. Review the record, and you will find that innovation is embedded in the fabric of the futures industry, and that the Commission encourages it, as it did with IPs. The Commission worked hard to resolve the regulatory issues that block the introduction of IPs. But let's be clear about one thing. An IP is not some novel form of security, and it's certainly not used for capital formation. There is no asset underlying the IP, none at all. The plain truth is that an IP, as it was proposed in the U.S., is a futures contract, and as such, must be approved by the CFTC in order to trade. Only the name is the same for the product trading on the Toronto Stock Exchange and the IP product originally proposed by the Philadelphia Stock Exchange. According to the Ontario Securities Commission, the Toronto 35 Index Participation Units, TIPS as they're called, are units of a trust. The Toronto TIPS represent ownership of actual Canadian stocks held by the trust, whereas a United States IPS had no underlying assets. So they are trading as a security in Toronto because they are a security. In sum, the Commission believes that the case for shifting jurisdiction over stock index futures to the SEC or for merging the two agencies simply has not been made. Jurisdictional gerrymandering will disrupt our markets, the most effective in the world. Proposals to permit the SEC to administer parts of the Commodity Exchange Act or to regulate stock index futures would only increase regulatory costs and confusion. Eliminating exclusive jurisdiction could result in regulatory chaos by allowing futures, which all have the same economic purpose, to be regulated under multiple and different regulatory systems. It would invite the states or other federal regulators to impose rules, sometimes even conflicting rules, that could undermine the efficiency of futures markets as international hedging and price discovery instruments. Market users who now trade with confidence and assurance in a familiar market system and under long-established rules would face a transition period fraught with regulatory uncertainty, and an 18-month study begun after radical regulatory shifts occur would only prolong the uncertainty. The futures markets would become less liquid and efficient and ultimately could be replaced by overseas markets, which could be perceived as more active and stable. Finally, the impact of the proposed jurisdictional change on the CFTC would be enormous. As you well know, financial regulatory agencies are having a hard time recruiting and retaining experienced personnel. Splitting off stock index or financial futures from the CFTC would result in a loss of some of our most experienced personnel, which would damage agency morale and threaten our ability to oversee the remaining markets within our jurisdiction. Under the existing regulatory structure, the U.S. has the oldest, most liquid, most innovative, and largest futures markets in the world. It's high time we return to the work of keeping our financial markets strong and preparing them for the challenges ahead. International competition in Europe and the Pacific Rim is already here, and there is much we must do to ensure that our statutory goals are met in an increasingly global and automated market. In order to meet these goals successfully, we must enact the provisions in our reauthorization bill to enhance our ability to oversee our domestic marketplace more effectively, as well as to police for international fraud. Thank you very much.
Thank you very much, Dr. Graham, and I appreciate your testimony. And Chairman Greenspan, I appreciate you being here, and I know you've testified on a similar subject before the Banking Committee, and I appreciate you coming here to testify before us. It's all yours.
Well, thank you very much, Mr. Chairman, Senators. I will try to excerpt from my testimony, and I would suggest to my friend Rudy Boswich that he try to keep up with me. I'll try to stay sequentially.
Small words.
It's certainly a pleasure to appear before this panel today to discuss issues involving the regulation of securities markets. The Federal Reserve Board does not believe that the existing division of regulatory authority has increased volatility in the securities markets, nor in this regard is it a threat to the capital formation process. Volatility in equity markets rather reflects economic fundamentals and changes in financial processes prompted by technological advances and the increasing concentration of assets in institutional portfolios. Efforts to restrain volatility by imposing more restrictions on particular markets or instruments could have unintended effects, resulting in significant costs on the system and a shifting of transactions activity offshore. We continue to view the primary purpose of margins to be to protect the clearing organizations, brokers, and other intermediaries from credit losses that could jeopardize contract performance. As such, they are one important element of a package of prudential safeguards, including capital requirements, liquidity requirements, and operational controls aimed at limiting the vulnerability of the financial markets to losses or disruptions arising from the failure of one or more key participants. The Federal Reserve Board remains skeptical, however, of whether setting margins on stock index futures at levels higher than necessary for prudential purposes will reduce excessive stock price volatility. Although available statistical evidence on the relationship between margins and stock price volatility is mixed, the preponderance of that evidence suggests that neither margins in the cash markets nor in the futures markets have affected volatility in any measurable manner. Thus, in the board's view, the critical question is whether margins on stock index futures have been maintained at levels that are adequate for prudential purposes. We have concerns about the tendency for these organizations to lower margins on stock index futures to such a degree in periods of price stability that they feel compelled to raise them during periods of extraordinary price volatility. In the board's view, somewhat higher margin levels on stock index futures would obviate the need to raise them in a crisis and thereby reduce concerns about the reliability of our market mechanisms, especially clearing and payment systems in times of adversity. The Federal Reserve Board believes that federal oversight is appropriate to ensure that margins on stocks and stock index futures are established at levels that are adequate under a wide range of market conditions. The appropriate federal agency should have both the authority to initiate changes in margins on stock index futures and the authority to veto changes proposed by the relevant SRO. Either the CFTC or the SEC could play this role. On this jurisdictional issue, there are different views among board members, but we agree that the Federal Reserve should not be given authority for futures margins and that our existing authority for stocks and stock options should be transferred to the SEC. The principal argument in favor of assigning oversight responsibility for stock index futures to the CFTC is that it has overall responsibility for prudential supervision of futures exchanges and clearing organizations and futures commission merchants. The principal argument for assigning oversight responsibility for stock index futures margins to the SEC, position for which I personally have a slight preference, is that it would foster consistency of margins in the stock and stock derivative markets. The Federal Reserve Board as a whole believes that margins in these markets should be consistent in the sense that they provide comparable protection against adverse price movements. The degree of protection provided by margin requirements depends on the magnitude of potential future price volatility. Although studies of past price movements can shed light on potential movements in the future, the forecasting of future volatility necessarily involves elements of judgment. Because different agencies are likely to come to different judgments, there is a case to be made for having only one regulator with margin authority over all the equity products markets to achieve consistency of margins across these markets. This alternative would help achieve consistent prudential regulation across these tightly linked markets for equity instruments. However, such a measure would result in two regulators of futures exchanges and futures clearinghouses, and hence would still require a considerable amount of coordination on the part of the SEC and the CFTC. One must recognize that stock index futures are but one of many futures contracts offered by these organizations. Indeed, only one of many financial futures contracts. Should losses from stock index futures trading, to be subject to SEC regulation under this alternative, jeopardize the financial integrity of a clearing organization or futures brokerage firm, it would threaten contract performance on all of the futures traded by the entity, including tangible commodity futures. Similarly, a failure in the commodity futures markets could, because of the effects on the clearing organizations or brokerage firm, have consequences for the equity markets. Secretary Brady, in listing several various alternatives earlier this year, has suggested much more far-reaching measures as possible to deal with the jurisdictional issue. For example, the transferring of all financial products to the SEC or the merging of the two agencies, although the current proposal obviously falls far short of that. We at the board, the Federal Reserve Board, would urge caution in considering any of these alternatives. A full merger of the two agencies would avoid many of the problems just mentioned about overlapping jurisdiction in the regulation of exchanges and clearinghouses, and the transfer of all financial instruments to the SEC might be accompanied by the separate clearing of all financial futures subject to only one regulator. However, these solutions would concentrate a great deal of regulatory authority over the financial system in a single agency, and this has been a concern of the Congress for a long time. We should not lose sight of the fact that under the existing system of split jurisdiction over financial instruments, our financial markets have been the most innovative in the world, with many of the new products spurred by the introduction of index futures and other futures. Thank you, Mr. Chairman.
Thank you. We have a vote. What I'm going to do is suggest there is a vote on that we recess for 10 minutes and then come back and immediately start questions. If there are more than, if there's going to be more than one vote, I will still come back between and try to get the questions started. Stay on recess for 10 minutes. Your timing, Chairman, was fantastic. I don't know how the Federal Reserve Board does it, but it's
Well,
I'm going to make it easy for others. I'll start in, and people will be coming back as they can. Now, first off, I should note I appreciate the testimony of everybody here today, and I know that you have spent, each of you has spent a great deal of time in it. So let me just go back and kind of refer to some of the testimony and see where we go from there. Secretary Glover and Chairman Breeden, you have in your testimony, if I could just summarize a little bit, and feel free when I finish to correct anything you don't think is correct in my summary, but you propose to strip the CFTC of jurisdiction over stock index futures contracts and transfer that duty over to the SEC. Now, such an idea raises a couple questions in my mind, two key questions. The first would be, could the SEC handle this new responsibility better than the CFTC does today? And secondly, would such a move cripple the CFTC in carrying out its remaining duties? And I mention those 2 points because they'll be in the front of my mind as I also ask questions of Chairman Graham and Chairman Greenspan. Now, as you know, this committee has been determined to clean up the Chicago exchange floors from trading abuses. It's a problem that's affected stock index futures as much as any other commodity, and I might say that the vast majority of those involved in trading want us to clean up any such abuses. Mr. Breeden, you've also argued that the SEC control of stock index futures could help prevent another stock market crash like we saw in '87 or '89. So basically, as we look at this, we have to know what your plans are. If Congress gave the SEC the power tomorrow, we'd have to know how you propose to accomplish the goals of preventing trading abuses while limiting volatility in the stock market. In that regard, let me go to just a few specifics. If the stock index futures were regulated by the SEC, and I'll direct this, Mr. Breeden, to you. If stock index futures were regulated by the SEC, would you allow these contracts to continue to trade under the open outcry system? Or would you force them to trade through exchange specialists or under a multiple market maker system like stock auctions at the CBOE? Chairman Breeden, what about you?
Senator, there are a variety of ways in which one could alter the both legal status and trading practices. If a change were made, one could treat stock index futures as securities and try and have them conform to the system in the securities world, or one could continue to treat them as futures and continue to apply the Commodity Exchange Act and the existing, start off with the existing rules and regulations of the CFTC that apply to those markets. I tend to favor the latter approach. I think that the logical and natural starting point is to simply provide that the existing law would be administered in the case of equity derivatives by the SEC, and in the case of financial futures and agricultural commodities other than equity derivatives by the CFTC.
But does that mean on the stock index futures, if they were regulated by SEC, you would trade them under the open outcry system?
Yes.
Would you ban dual trading in the futures pits where a broker executes customer orders, also makes personal trades, or would you limit the dual trading to small inactive pits, or to trading floors where the exchange is able to police the practice against abuses?
Well, if I can, and I don't know how long the list of items that we want to run through is, but just as an overview that would be a caveat to my answer to any of these types of questions, how we would do something, that very much depends on the mandate that we would be given by Congress. It's Congress that would establish the rules, would decide, for example, whether the existing trading system and CEA should be continued or whether something else should be developed. We are perfectly comfortable in taking as a starting point the existing statutory requirements that have been laid down by the Congress and by this committee. To the degree that there need to be changes, the first thing we would want to do would be to solicit a wide spectrum of public comment from to the degree it was a rulemaking question where we had discretion, would be to solicit the views of the industry and others on how a given question should be addressed in exactly the same way we consider the public's views before we act on proposals under the securities laws. So I can't sit here and just say, here's how I would do all these things. It would depend on rulemaking and notice and comment and
except that we are making some changes in the legislation that's now before the Senate that was just passed unanimously out of this committee. But obviously, if future trading is turned over to the SEC, this has to be a major trading practice concern. What would you favor, you personally?
I would favor eliminating dual trading. We do not utilize dual trading in the among floor brokers generally in the securities markets. And
can't New York Stock Exchange specialists dual trade within certain limits?
There are in certain cases procedures under which specialists and others who have very carefully defined duties and limits can engage in trading practices. But in terms of a general approach, I would favor the restriction of that practice.
Well, you know, there are certain restrictions in our bill and others by practice. The CBOE rules ban same-day dual trading on stock options, for example.
Right.
Would you impose a so-called uptick rule on stock index futures to ban short sales when the prices have fallen?
Well, you know, there again, it would depend on what the law was that we're operating on, and I can't hypothetically answer what we would do. We would apply the law that Congress gives us. That's the way we operate and are required to operate. And we have interpretations under existing securities laws, and if the question is, would we try and apply every single interpretation of the Securities Act of 1933 or the Securities Exchange Act of 1934 in crafting rules under the Commodities Exchange Act, if that's what Congress asked us to administer, the answer is certainly not.
Mr. Klauber, how do you feel about this? I think you talked about the stock short sale, or the evasion of the stock short sale rule as being a problem, if I recall your reading through your testimony, Ms. So what would you recommend in that?
I think what I would do is point to the fact that this is one of those intermarket inconsistencies. There are good reasons why the futures market has not had an uptick rule. Futures markets are different from stock markets in some very real senses. The problem we wanted to point out was the linkage between these two markets, together with the set of rules in one market and the set of rules in the other, leads to an inconsistency, and we would suggest that what is needed is one regulator to look at both of those, and we would defer to the regulator in that judgment.
Let me ask another area. The Futures Reform Bill this committee has allows customers to collect punitive damages in civil lawsuits against floor traders in futures markets. It also holds retail brokerage firms liable for actions of independent floor brokers. Would you apply that rule to stock index futures trading as well as other commodities, Mr. Breeden?
Again, Mr. Chairman, I would, that's a question of the statutory standards that would be applicable. A system like that would not be created by rule, either ours or the CFTC's, but rather by statute. I think we would envision that the systems for, as I said, our preference would be to continue to treat stock index futures under the Commodity Exchange Act, and the systems that apply under that act to other types of futures would continue to apply to stock index futures, including the reparation system and the mechanisms you suggest.
Let me ask you a little bit about that. We do allow the punitive damages, as I said. Would you recommend that be extended to the stock market? Admittedly, we can do it legislatively. I'm just curious what your recommendation is, because securities laws doesn't have any punitive civil liability except in RICO. We put a tougher, I think anyway, a much tougher law in our Futures Reform Bill, much tougher law than the securities law. Should we apply this to the stock market too? If we're going to all be good and tough and all here, should we apply the same thing to the stock market that we have to the futures market?
Well, we'd like to start with the passage of the Securities Law Enforcement Remedies Act, which is pending before the Congress right now, which we think is very important. I'd certainly be happy to take a look at how the system you're describing, if it's enacted, works in the futures market and consider its applicability to securities, but I don't ever like to make recommendations for legislative action without carefully studying the merits of the issue.
Secretary Glauber, did you want to
That's, I think,
walk
again,
into that minefield?
I think I would not. It's a regulatory issue that really is beyond what I think I am competent to comment on.
Well, I ask these questions because if to follow what you have recommended, Secretary Glauber, in your, on behalf of yourself and Secretary Brady, and backed up by Chairman Breeden, you're asking for some major changes, and I'm trying to anticipate the kind of questions that are going to come up on the floor when this comes up. For example, if the stock index, we know what the futures market is under CFTC. We know what it is under our bill. If it is voted, if it's voted to send this over to the SEC, we're really sending it out into kind of an uncharted area where we don't know what's going to happen. So let me ask you this. Would you allow customers who defrauded in the stock index futures markets to continue to bring cases under a reparation system? Or would they have to press their claims before an industry-run arbitration panel? Which would you prefer, Secretary Glauber?
Well, as I said in my testimony, what we would prefer is to effect this change in the least disruptive way. That is, to do it in a way that preserved the existing practices in the futures markets. And I think that that's very important to try and accomplish.
That would be the reparation system?
Again, I don't feel that I'm in a position to comment on specific regulatory issues. As a general matter of policy, what I would like to say is that I think the philosophy underlying our recommendation is that the economic reality, the way markets work, ought to dictate the way they're regulated. These markets work as one market, and we think they should have one regulator, but that should be done in the least disruptive way possible.
Chairman Breeden, reparations or arbitration panel?
No, I would, again, and I'm speaking only personally since I haven't had a chance to ask this of my colleagues at the Commission, but I personally would favor continuing the reparations system, and indeed would think that it would be perfectly possible to continue the current administration of that system as it is at the CFTC, with appeals from the decisions rendered by that process being simply taken to the board of the SEC rather than the board of the CFTC. I think that would be smooth, efficient, and wouldn't be in the least disruptive to market participants.
Yeah, I want to make sure I understand this. If you had something that came before an administrative law judge in the CFTC, are they going to appeal to the SEC then?
Sure. Simply process the case under the existing system and take the appeal to the board. Not really much different than taking an appeal to one court of appeals versus another.
Would you have to add new administrative law judges to hear these cases?
No, I think the best thing would be to use the ones who are in place already. But we could do that. We have a core of it.
You would regulate and oversee this, but a reparations would be heard before a CFTC administrative law judge, but the appeal would then go back to the SEC. Am I following you correctly?
Well, that's certainly one way to do it, and I would think an easy way to do it. The administrative law judge can be on the employer. I mean, we have administrative law judges as well. We could use an SEC administrative law judge. They are supposed to be not representing the agency, but rather acting as a judge, and I think we could use as a finder of fact an ALJ employed by the SEC or the CFTC. In either case, you then take an appeal on that matter, exactly as we now take appeals, and the CFTC takes appeals from our respective ALJs to the board. That's a very simple process.
My time is up, but I want to know whether Dr. Graham wanted to add anything to that.
Well,
Or Chairman Greenspan, either one, and then I'll yield to Senator Lugar.
I guess I'm somewhat puzzled about how such a process would work. It might be awfully confusing for the ALJs and the CFTC staff who work on reparations to be reporting to, I guess, the SEC. Obviously, I do have some concerns about how such a proposal would be implemented. I would also have concerns about all the ongoing rulemakings that would cover not only stock index futures, but also all the other contracts as well, not only dual trading, but the trading card rule, the disciplinary committee rules, all of the rulemakings that are in process now. To what extent would they be halted and thereby changed if there were a shift in jurisdiction? We have a number of programs at the CFTC of monitoring the pits, for example, directly, and I think it could be very confusing if the SEC had a different set of rules, a different set of dual trading or trading card rules for those who are using the markets. I believe at this point in time the SEC does not directly monitor the floor trading practices of the securities exchanges, and so that's something that would have to be changed for effective monitoring of futures style trading. There are a whole host of questions that this proposal raises that I haven't had a chance to really think through, but it sounds like very, very confusing in my mind, and more confusing perhaps than even just shifting stock index futures jurisdiction over to the SEC directly, but the joint SEC CFTC implementation of the Commodity Exchange Act, especially if you eliminate the exclusive jurisdiction, could result in a tremendously confusing prospect for people who are on the floors of those exchanges, and therefore for the users as well, ultimately.
Chairman Greenspan, do you want to jump into this, Donnybrook?
I would suspect I have nothing useful to add.
I suspect you could, but I suspect you're not going to at this point. And I admire your wisdom in that regard, Senator Lugar.
Well, thank you, Mr. Chairman. As has been related already, this committee entered into the reauthorization of CFTC at a time of considerable difficulty in the commodities markets, and it seems to me we produced a bill that has great strength and merit, and I suspect would be able to come to conference with the House and brings at least confidence in terms of our role. I do not by any means diminish the importance of the amendment offered by my distinguished colleague from Washington, who has raised an issue of jurisdiction, and clearly either our colleague anticipated interest by the administration in this, or the administration signaled interest and he has followed through on it. But in any event, we have a situation, as I see it, Mr. Chairman, which we really need to bring this bill to the floor of the Senate. I hope, as you suggest, with a tight time agreement. I think the senator should have an opportunity to offer his amendment, and it'll rise or fall and be done with it. What I see coming here is a very broad-gauge study of jurisdiction and equities that surpasses almost all the testimony we had last year on the entire issue. And I admire the ability of Alan Greenspan always, but especially here, to try to sift through and find out that there is not a whole lot in these arguments. He comes down, I think he said, slightly with the disposition on one of the four major charges for reform. But stripping away all of this, it seems to me that there is a question perhaps that this committee might have taken a look at more carefully in terms of the prudential factor of margins, and to make certain that there is consistency in the margin situation. I think that comes through, at least in terms of my own sympathies with this testimony today. With regard to the volatility issue, every academic study that's flooding into us indicates there's not much in that. You can make a case for it any way you want to. Now, what I hear loud and clear and what I don't want to hear is, I suppose, the administration saying that we've had 4 large disruptions in the stock exchange in the last 2 years or so, and somehow that is due to the fact we haven't fixed this particular problem. And therefore, if you don't adopt our idea, heaven help you if we have a 5th, because we'll sort of lay that on your doorstep. Say, you're responsible. Now, that's irresponsible logic. When you have one academic study after another showing very, very little correlation in terms of the volatility argument. And I would just suggest that far from there being absolutely no apparent reason for the stock market falling from time to time, there appear to me a whole lot of economic reasons out there in the world why our stock market reflected that. One can always ask why one day as opposed to another. One could ask why the Japanese stock market didn't fall before this year, even though almost everybody felt there were large dislocations there that are now being reflected. And some would even say the Japanese market is the consequence of their taking instruments from the United States over to Japan, foisting that difficulty upon themselves. So Mr. Chairman, I hope that we can move on this issue. I think there is probably merit in taking up each of the items that have been discussed today, and it may be that in an independent package of reform that something will come of it, but I must say I don't see very much at this stage. Now I'd like to ask Mr. Greenspan, since I've cited his testimony, in trying to get to the prudence question with regard to margins. You suggest that could be done in several ways and that it's probably a desirable thing to do. Playing the ball from where we are now, is this an issue or a power that should be taken from the exchanges and given to the CFTC? Or you've said that you don't want it at the Fed, and therefore it might, I guess, go to CFTC or SEC under your testimony. But is one potential cure for this committee to say amend the act and say, as opposed to the exchanges setting their own margins, the CFTC will do this in the future?
Senator, on the question of margins, the issue really breaks down into an insoluble problem, which is essentially that you can either look at margin coordination on the basis of the particular exchange with which you are dealing, so that one regulator sets the margins for all of the products that are traded on a specific exchange. That obviously has certain advantages because it enables the regulator to go across products with individual members and to get what that regulator would presume to be prudential margins from the point of view of the exchange as such. The alternate, and in a sense, the mutually exclusive procedure is to try to present margin calculations on the basis of products which are determined by the same set of price-making forces. The only way in which you can get a resolution of this discrepancy of approach is to have essentially only certain types of products on a certain exchange, or only one product per exchange. In this particular instance, I've looked at this in some detail, and my board members have taken several different positions on this, and we don't agree. I particularly think that because the price-making mechanism is the more important of the two by a small margin, I would tend to be favorably disposed towards putting the index futures and the stocks under the same regulator so that we do not have divergent views about the future of these markets being reflected in different evaluations and hence presumably different prudential margins from index futures on the one hand and stocks on the other. In other words, I'd like to see them at least inferentially reflect the same price-making forces.
And is there any way to get to that point then, aside from, while you're trying to cure the margin situation, your recommendation is that you meld all of these instruments together under one jurisdiction? Yeah.
Well, no, I find that the administration's proposal that Undersecretary Glauber brought forth this afternoon does actually implement the view that I personally hold. There are other ways, obviously, of doing that. The one thing I would, as I indicated in my testimony, I would strongly suggest that one avoid is endeavoring to merge these two organizations, for I fear that that would not be useful in maintaining the optimum regulatory system in this country.
I thank you. That's my only question, Mr. Chairman.
Thank you. I might say, incidentally, Senator Lugar is absolutely right in his comments about let us not blame the ills of the world on the immediate progress of this particular piece of legislation. But I would be happy to join with the distinguished senator from Indiana in sending a letter to the two leaders of the Senate, urging, one, that it come on the floor, and secondly, that it come on the floor on a relatively tight time agreement. The major issues that we have in the bill itself were debated at some length and were passed with a great degree of unanimity. I don't think that those are the parts that take much time. But I would, and I'll work with the senator from Indiana to see if we can possibly get something like this on the floor. I would love to see it on no more than a 2-day time agreement. Vote these issues up, vote them down. All the more reason, I might say, all the more reason why the importance of your answers to the questions, and why Chairman Breeden and Secretary Glauber, these are not just the questions I was asking, are not just for academic interest. I'm anticipating that this matter will be on the floor, and Chairman Graham and Chairman Greenspan will be on the floor, and a lot of questions will be raised by different senators, and I want a clear enough record so we can be able to respond to them. That's why I'll also have extensive, as you can imagine, extensive questions for the record, which was submitted. I want you to look at very carefully because they will be part of that debate. Let's see, next on the list we have here are Senator Gorton and Senator Kerry and Senator Fowler and on. Senator Gorton.
Chairman Greenspan, you just answered
Bond and Boswich.
The question which I was going to put to you, and while perhaps without quite the degree of enthusiasm that I do, we are in accord on both halves of that answer. This consolidation, but not a merger of the two agencies. Perhaps an appropriate follow-up to that on the part of this senator is simply to say that this, from my point of view, is an institutional problem and not a criticism of the chairmanship of Mrs. Graham of the CFTC, whose reappointment I support very enthusiastically. And I just wondered whether or not you'd favor the committee with whether or not you feel that she ought to be reconfirmed as chairman of the CFTC.
Most certainly. I think she's been a very effective chairman and been extraordinarily easy to work with within the working group and in problems that we've had jointly. So I certainly would hope that the Senate will move expeditiously on this issue.
Thank you very much. My next question is to Secretary Glauber, and really is a follow-up on that. Is this problem, from your perspective, Mr. Secretary, a failure of the FTC to do its job, or simply is it endemic in the current regulatory structure and the division of the regulation of the subject matter of this debate?
No, I think the problem is we are asking regulators to perform an act which is very, very difficult, and that is to have two regulators try and regulate what is one market. It's a problem of regulatory structure, not of agencies, and certainly not of people.
CFTC, as I understand it, Mr. Secretary, was originally established to regulate commodity futures, and it's in the course of the last 8 years that the jurisdiction over stock index futures has been added. Do you feel, on the one hand, that the CFTC, by reason of this addition, has gotten away from its original mission to a certain extent? What would be the significance, or is the significance, of CFT regulation of stock index futures to the agricultural community?
Well, as I said in my testimony, I think they are obviously not closely related at all. I think the significance has been that this debate has distracted them perhaps from their traditional regulatory responsibility. I think that if this were cleared up, they could turn their attention back to those issues. If I might just return to something that Chairman Greenspan said, I think I view it in very much the same way. That is the issue of where stock index futures should be regulated. They are on the one hand a future, and on the other hand they are very, very close to being like stocks. And it is a judgment that one has to make. Do you push them one way or the other? The decision was made 8 years ago to push them one way towards futures. I think we would likely draw the line on the other side today if we were doing it again, knowing what we know now, and indeed faced with the information that we now have, or they now have, other countries, when they've designed their regulatory structures, have chosen to push stock index futures towards the regulator that does stocks.
Well,
Mr. Chairman, could I interrupt at this point? Have you included in the record your letter to the Secretary of the Treasury of March 20th, 1990, and his response, which is dated today? Not, can both of them be included in the record?
If they're not already in the record, they will be.
Chairman Breeden, the same question in just a slightly different formulation. Why, in your view, is it either better, more effective, more efficient to give the SEC jurisdiction over stock index futures rather than to rely on coordination and cooperation between two separate independent agencies?
Well, I'd like to, Senator, I'd like to, at the outset, associate myself with Chairman Greenspan's comments concerning the job that Chairman Graham and the CFTC have done, and we share the view that this is not an issue of one agency doing a better job or another. It's a question of the structure, and whether the structure that we now have is as good as alternatives in helping us deal with the potential of fraud, helping us deal with the potential of instability, serious instability in the clearance and settlement system when we have market crises. Not this issue of volatility, with due respect, that's a bit of a straw man, but the issue of whether the low levels of margins, near zero, when we hit a crisis point, makes the stress on the system infinitely greater. The question of whether the current system is a good one in promoting competition, it has helped do that. But it's also, over time, allowed barriers to competition, very serious barriers to develop. So for these and a number of other reasons, we believe that a system that paralleled that is in place in England, in France, in Japan, in all the other major countries that we compete with, where the single agency is able to regulate stocks, options, and derivatives on stocks, would be the best possible system. We would promote competition, we would be better able to deal with fraud, and we think we, particularly in changing this margin system, would do a much better job in protecting the stability of the market for the American public.
Thank you. Mr. Chairman, I want to thank you for calling the hearing and for this opportunity to ask questions, and simply to associate myself with your remarks and those of Senator Lugar that it is time to bring this to a head, and I will certainly cooperate with each of you in attempting to see to it that we can do so in an orderly and expeditious fashion on the floor of the Senate.
Thank you very much. Senator Kerry.
Thank you, Mr. Chairman. Let me just, for the record, Chairman Breeden and Chairman Graham, for your information, I mean, I must tell you that I have a rather low opinion of the job that the SEC and the CFTC have done. It seems to me that what we have here is an unfortunate public display of a jurisdictional conflict where there is minimal compelling evidence that we should transfer jurisdictional authority. That's the conclusion that I've reached. I would like to ask Chairman Breeden, you referred on a couple of occasions to the observation that you've made that there is fragmented regulation, and that seems to be a rather important thing in your mind that we attempt to eliminate. Do I have that correct? I mean, do you observe fragmented regulation to be something that we ought to work vigorously to eliminate?
In this particular area of stocks, options, and derivatives on stocks, I would agree with Chairman Greenspan, have really looked at some of these issues for years, that there are benefits to having a regulatory structure in which there is a certain amount of decentralization, in which we do not have a single agency that makes every decision about every financial product. I don't think anyone here is suggesting that, but that at some point decentralization becomes very unproductive, and at some point you do need to get a consistent answer to problems that cut across product lines, and that clearly, in my judgment, is the case in the regulation of stocks, options on stocks, and derivatives on stocks.
I have difficulty with the argument that you've isolated this particular instance of fragmented regulation. I know that you were very actively involved in the drafting of the FIREA legislation. I mean, I'm looking at the interconnected lines for the FIREA legislation. I mean, it seems to me to be a textbook example of fragmented regulation. And it didn't seem to me that when you were, it was apparent to me at least that this bogey of fragmented regulation didn't frighten you off when you drafted that particular statute.
Well, Senator, with all due respect, it was much simpler. The chart was much simpler when we sent the bill up than when it came back down to be signed. I think the issue of how complicated that statute became, I think there are a great many people who had a role in that.
Did you recommend a veto of it then?
No, absolutely not, and I think...
Just want to check. I'm sorry, I went into Senator.
Well, I mean, I am genuinely trying to listen to all the presentations and consider whether or not this transfer of authority should occur, and I do find an absence of a compelling case that there is something here that needs to be done immediately, otherwise we're apt to have a regulatory environment that's going to restrict innovation and restrict the flow of capital and make it difficult for us to compete internationally and all that sort of thing. I mean, I don't see the documented case being made, and as a result, I do conclude that this is essentially a jurisdictional battle, and as I said, I don't, with all due respect, and as Secretary Glauber himself said, the CFTC, it's doing a good job under the circumstances. There is in that statement some extenuation that I have made as well in my analysis of the job that's being done. But if you measure the output, if you look at just the raw data of the last 5 years of the SEC and the CFTC, you know, one has to really push hard on extenuating circumstances, I think, to reach the conclusion that there's a good job done.
Well, let me follow up a little bit since Senator Nebraska's time is up. Or he stopped uncharacteristically, but I was listening to him. Secretary Glauber, if I was also listening very closely your regulation answer to the Senator from Washington, if we gave the regulatory authority over stock index futures to the SEC, you think that SEC would be able to prohibit 100-point swings?
No. What I did say in my statement, and what I'd like to try and emphasize, is that I think that the regulatory structure leads in a variety of directions to the potential for market disruptions and for a reduced set of tools to deal with those disruptions when they occur. In particular, I'm talking about the need for better integrated clearance and settlement, better integrated circuit breakers, tools which would help us deal with those disruptions as they evolve and when they occur.
Well, I know you were listening to my friend from Indiana talk about those externalities. You're not making the case. I know you were very careful not to make the case in your prepared testimony, but again, your answer to Senator Gorton leaned heavily on the fact that somehow the regulator would be better able to somehow the regulator would have more weight than market forces in the final result. I assume you don't really believe that.
Senator, I certainly did not want to suggest that market forces can be overridden. What I did want to suggest is that I think when market forces occur, we need to have in place the tools to deal with them, and we're more likely to have them with unified regulation. If I might also just take this opportunity to comment on something that Senator Lugar asked broadly before, but we moved on to other things. And that's the issue of volatility. I could not agree with you more that there is no good evidence that average volatility levels have increased recently, or that there is a relationship between average volatility levels and margin levels. I think it would be very hard to measure it if it did exist, because there's so many other things going on. But it really isn't average volatility that concerns me or concerns the Secretary. It really is this potential for these brief, violent periods of market disruptions when the pricing mechanism between the stock market and the futures market seems to come apart. And when we get really totally disoriented kinds of results, when futures prices are selling at a 250-point discount to stock prices, when instruments cannot be opened for trading successfully because of the supply-demand imbalances. I think this is something quite different from average levels of volatility. I think the analogy I would make is to a river whose average level is perhaps 2 inches, but in which somebody could easily drown because they'd happen to be in the part of the river that's 20 feet deep. So I don't think we should look at average levels of volatility, nor rest assured because average levels of volatility have not increased. I think there's a quite different phenomenon going on here. Excuse me for diverting Senator Fowler.
You're excused.
Thank you, sir.
What is it? Why don't you itemize for us what you would do differently?
Well, I tried in both my spoken statement and the written statement to catalog the areas in which I think we have unharmonized, uncoordinated market mechanisms, margins, but beyond margins.
You've seen those studies by the Fed, I'm sure, that do not support your thesis that higher margins will decrease volatility.
That, again, Senator, is not really the thesis. What we've said is that we need margins set by some federal regulator, or at least overseen by a federal regulator, set by the exchanges, but overseen by a federal regulator, in order to make certain that the entire financial system is not exposed to disruptions. What's done in one marketplace can disrupt other marketplaces, and therefore there needs to be coordination. I don't want to suggest, and perhaps by the way I spoke I misled, that
nobody's arguing that there shouldn't be coordination. The question comes back to what Senator Kerry said, and even though it's denied in Secretary Breeden's testimony, and by implication everyone's, that this is not a turf battle. It just continues to walk like a duck, quack like a duck, and act like a duck. We're for coordination through the CFTC. We've taken all these audit trails, much more stringent capital requirements, price limits. SEC is just now coming around to ask for some of these things. They weren't leading the pack despite the historical review that Chairman Breeden gave us in his testimony. But I've been here trying to listen, and it's not very compelling. Let me ask Chairman Breeden a couple of questions, and we don't know each other, but might as well say it man to man. I appreciate the restrained, your restrained printed testimony, but doesn't help matters, it doesn't seem to me, in your Saturday interview in the New York Times, where it looks to me like a good example of pot calling the kettle black. start jumping on the Congress. At least this committee has been working on this problem for 18 or 20 months. If you look at the S&Ls, we met the President's request as the #1 order of business last year when you were involved to get an S&L bill. He said do it in 90 days. We did it in 90 days. Just got around to appointing the head man a year and a half later. That's not the Congress's fault. It seemed to me if we want to work out this situation in the public interest, including full disclosure and as much requirements oversight as we can to keep confidence in the markets, whether they're located in New York or Chicago, I might add, that this business of firing shots across everybody's bow and bragging that you can do it better, especially after what's been happening, the scandals that have plagued the markets in recent months, again, is not a very compelling way to approach public policy. Be glad to have your response. I know that was, but I'm responding, this is the congressional response, one congressional response to your interview. Give you maybe the last word and maybe the next to last word.
I've been in these events often enough to know it won't be the last word on this side of the table, Senator. I would like to, I'm glad you raised this article, the remarks, because I had been hoping to have a chance to respond also as well to Senator Leahy's initial comments. I think since everybody has expressed a great interest in this, it might be useful to put in the record, along with everything else, the specific article, because I think the remarks have been variously characterized incorrectly.
I will put it as an addendum. I think in fairness to you, Mr. Chairman, it should be in the record, the whole thing. And if you give us a copy, we will put it in the whole speech in the record.
I want to make very clear that the article did not suggest that there were parallels between, my remarks did not suggest that there were parallels between the S&L fraud and the degree and extent of the disgusting degree and extent of fraud in the savings loan industry and any other industry, most particularly futures trading. I did not, as Senator Lugar suggested, say that there was a close analogy between the savings and loan problem and this one. I did not, Senator, as you suggested, blame the Congress for that problem. I simply said, and the exact words were, that there were some disturbing parallels between the debate about that situation and this one. And there are some parallels. I'm not claiming, suggesting, and never have, that there was a close connection here between these two problems or that they're directly analogous, but there are some parallels. In the thrift situation, for years and years, that problem grew, and there were a number of attempts, including suggestions by the Secretary of the Treasury to cure that problem, to begin to take steps, and it took years in order for our process to begin to react. That was not solely a fault of the Congress, although Congress is one element of it. Certainly the administrations and regulators also had a part of that, but the process was very slow, and the end result was billions and billions of dollars in damage to the public before action and a result occurred. There was a significant element of the debate about leverage. The thrifts argued that they ought to be able to compete with much lower levels of capital, 2–3%, sometimes close to zero, just as the futures industry is arguing, I gather, that our suggestion that we should reform a system that allows 98% leverage in the positions that are carried in the stock index futures is too much leverage. There ought to be a little more investment made by the people carrying these positions than there is. And that's a parallel in the degree of the extraordinary degree of, if you will, hyper leverage that existed in the thrift situation. And while there are differences, there's certainly, we believe, and one of the strongest cases we think for some change in this area is to correct the over leverage in the current stock index future situation. In fact, that's a view that we're not alone in. The Treasury Department has expressly stated the same concern. Chairman Greenspan stated in the Senate testimony that he was shaken by the events in last October and the need to very sharply raise futures margins in the midst of the crisis. Federal Reserve of New York President Jerry Corrigan, in a recent speech, said, and I quote, "I believe that margins in many financial-type futures instruments are typically, if not systematically, too low. In the case of the S&P 500 contract, for example, it seems to me that a significantly higher margin, perhaps as high as 15% or so, is always called for," close quote. So we're not alone in suggesting that leverage is a problem, and it creates a risk for the system. It's a risk we don't have to run. The futures markets did carry much higher margins for a year after the '87 crash. It didn't drive trading to Japan. It didn't cause a destruction of the marketplace. It was a prudent thing to do, and we ought to continue that. And I've simply tried to urge that Congress and the regulators, hopefully working together in a partnership, to try and identify where there are risks and where we can improve our system. And I think you cannot really argue, or at least I wouldn't argue, that the current system is the best we can do to control fraud, to control risk to stability, or to make a competitive system in which we minimize the regulatory hurdles and let people get out and compete in the marketplace.
Weren't there literally thousands of complaints filed against the securities professionals since you brought up the '87 crash, stemming from the alleged abuses on options, derivative products that the SEC regulates?
I'd be happy to provide you with the number of complaints, letters.
But you know the answer to that. I'm not asking for the exact, but it was in the thousands. At least that's according to my information.
I know I have had 14,100 and some letters since the October events demanding from individual investors all over this country, demanding that we do something about the shocks to the securities markets and what they see going on in index arbitrage and some of these practices. So we get a flood of letters on all kinds of topics, and I'd be happy to give you the statistics.
Well, I just think it's just very interesting to me, and I allowed you to give your full defense, which I appreciate, of the article. But again, it belies the tone in which you used, and there were no specific suggestions in this article, not a single one. It was a broad-based attack saying, I'm not trying to polarize, we're just going to focus on the merits. No discussion of the merits. And then your first quote was blaming the Congress for failing to act.
Senator, you know as I do that we can't control what the reporters choose to write. We have been discussing, and I have discussed at length with the committees and with reporters, the substantive problems. Our testimony is filled with it. We've chosen to do that, and we've consistently done that. And you can characterize it however you wish. That's certainly your right. I didn't intend any attack on anyone. We have tried to discuss this as the serious policy issue. We think it is. We think that the marketplace is placed at risk unnecessarily by some of the practices that exist, and we think we would be remiss as regulators if we didn't advise the Congress of that fact.
Well, I appreciate that, but as one who spent 14 years in the Congress, all I can say is I'd like to have a chairman and a regulator who speaks with specificity to the press and ought to know better if you're going to claim that you're misquoted, especially since you're given credit for being one of the architects of the S&L provision. You knew exactly what you were doing. And I do not think that that helps the process that we are undertaking, the job of this committee that we've been working on for 18 months, all of a sudden you weighing in with specific words that cannot be misconstrued. Congress didn't act, blaming Congress. Talking about polarization when there has not been any polarization evident, I can say, to the chairman and the ranking member coming out of this committee. Thank you, Mr. Chairman.
Senator Boswich.
Thank you, Mr. Chairman.
and Senator Bond. I'm sorry I gave the order the wrong way before, but I found my notes. It's sort of like extricating one of the Dead Sea Scrolls. I found my original list, and I do remember you being there warming that seat in your distinguished fashion, Senator Boswich, and so you are next, and Senator Bond is next.
Thank you, Mr. Chairman. Pardon me? Mr. Chairman, I am a great admirer of the financial markets of this country, and I also very much agree with the statement by Senator Lugar that he made at the outset of his questions. I've participated in the financial markets of this country over my adult life, and indeed even as a kid, because my father was a stockbroker for Payne, Weber, Jackson, and Curtis for many years, and I used to go down to the exchange as a child and grew to like it very much. Let me tell you, Mr. Chairman, Mr. Breeden and Graham, also for our chairman, let me tell you that I'm very disturbed to see this jurisdictional fight between these two agencies. I would reread the Chairman Greenspan's final words when he said we should not lose sight of the fact that under the existing system of split jurisdiction over financial instruments or financial markets have been the most innovative in the world, with many of the new products spurred by the introduction of index futures and other futures. The kind of jurisdictional fight, as I watch them here in Washington, this kind of jurisdictional fight gets pretty fierce. Let me say to both of you, but particularly to you, Mr. Breeden, that this senator is going to very carefully watch what you do. As a matter of fact, I've hired staff who has a master's in the futures market for that purpose. Agencies have a way of biting at one another. Agencies sometimes aggressively attempt to make one another look bad in an effort to increase its jurisdiction. A turf war led by the SEC to gobble up the CFTC better not become one where the SEC seeks to make the other agency look bad. Our financial markets are too important, in my judgment. Our financial markets are too fragile to be subjected to ambitious regulators. So I'll watch and I'll ask others to do the same, and the staff to do the same as well, not only on this committee, but on the banking committee. I know you will tell others in this committee that you're just trying to improve the system. From where I sit, both your agencies have their problems, as the senator from Nebraska, and I join with him in his remarks. So those who enter turf battles that endanger markets, which I think are the underpinning of the financial elements of our nation, those who enter those kind of turf battles really do so at their own risk. And I would say, Mr. Chairman, that we're going to watch very carefully. I would say, I would ask Mr. Glauber, you say that you feel that a single agency would be more streamlined. But what reason am I to believe that a bigger agency is going to be an agency that is going to be able to act more effectively or quickly? Mr. Breeden said in his testimony, all monopolies create inefficiency, and this is no exception, referring to something. But
the exclusivity clause.
Pardon me?
The exclusivity clause of the Commodity Exchange Act.
In referring to the exclusivity clause, which is not totally exclusive, but nevertheless, in referring to that, all monopolies create inefficiency, and this is no exception. Why will this streamlined so-called larger agency, why is it going to be streamlined? Why will it be able to act faster and more effectively?
Well, Senator Bosch.
I find around here, the larger the agency, the more difficult they are to deal with.
Well, Senator Boschwitz, as you know, we have proposed really the minimalist approach to trying to deal with just these problems, and that is to move jurisdiction of stock index futures to the SEC, and not to combine the two agencies, which I think would suffer, has certainly the potential of suffering from the concerns you raise. I think the reason it would work better is that regulation then, the structure of regulation, would follow the economics of the way the markets are working. I think as long as we ask two regulators to try and regulate one market, it has to lead to inefficiencies. And that's why I said I think it would be more streamlined and effective.
Well, my experience is that the larger the agency, the less streamlined it is, and the more difficult it is to operate with. Let me talk about margins. What are the present margins in the United States on futures compared, for instance, to the Japanese margins? Are you familiar with that, Chairman Breeden?
Yes, the margins in Japan, and they differ somewhat between the different contracts, between the Nikkei index and the TOPIX index. There's a minimum, the margin must be the greater of 6 million yen or 9% at current times. The 6 million minimum applies to some transactions and not others. In some cases, that results in a margin that may be as high as 26% if you're applying the 6 million yen minimum to the current value of the contract. Otherwise, it's a 9%. It's a 9% level.
That's for customers. What about for members?
I don't know the current. I believe it's 6% for members at the current time.
And what about how does that compare with American margins?
Well, we have a very complex system, and the basic comparison is that in Japan, the government of Japan oversees the establishment of the margins on futures, options, and stocks through the Ministry of Finance, and in the United States of America, only stocks and stock options are overseen by the government, and the safety of the marketplace in the case of stock index futures is not under any oversight, direct control by the U.S. government, but is left totally to the private boards of directors of the futures exchanges. And we have felt that disparity is a weakness.
I asked what the margins were in the United States, and the margins in the United States are certainly comparable to what they are in Japan as percentages. And as I understand margins, the margins in the future transaction, and perhaps Chairman Graham can also comment on this, but the margin on a future transaction pretty much covers the entirety of the risk, and very often is larger than the risk. And it changes on a daily basis. Is that not correct? The entire exposure is covered by the margin, not the entire value of the underlying stocks that are covered by the contract, but the entire exposure. Is that not correct?
I'm not sure that I understand the question, the entire exposure of the...
Well, the exposure as you go up and down, let's say on a corn contract or on a futures contract, that the margin is increased is if the...
Oh, you're probably referring to just the future style margining, where if the market moves against you, you do make additional payments. That's right. You do mark to market.
You have to keep monies on deposit there.
That's right.
So that the entirety of your exposure, as I understand it, is covered by the margin, is it not?
The entirety of the moves. The market moves.
The entirety of the movement.
Right. That's right.
It's not clear to me why it's necessary to increase that margin, Chairman Breeden. Have we characterized the margin correctly?
No, I don't think you have, Senator. And the comparison with Japan is also skewed by the fact that they have 3% price limits there, and therefore margin plays only a portion of the role in dealing with extreme price movements. We don't have any comparable limits in the U.S.
They have 3% price limits on stock index futures?
Moves in the futures price limits, yes, sir.
Within a given day?
In a given day, yes. And we don't have such a system, so that margin doesn't play as large a role in Japan as it does in the U.S. because they have something additional that we don't have, these price move limitations.
But as that exposure increases, it's my understanding that there may be margin calls 3-4 times a day.
There can be, and that's what creates the risk. That's what Secretary Brady, Chairman Greenspan, New York President Corrigan, and I have all pointed out is the weakness. It's the fact that if you go into a crisis, if you set your margin based on a normal day, and you enter a problem day at 2.2%, as we did in 1987, as we did in 1999, then it becomes necessary to sharply and dramatically raise that margin right at the time when the market is in the midst of a crisis. And that then requires payments, substantial payments, and at the afternoon of October 13th, 1989, it was more than $500 million in payments that were required on the stock index futures market because of increases in that margin rates. Well, at the moment the market is in its worst crisis and you're hoping it's going to bounce back, that's an unfortunate time to be collecting $500 million in extra margin that is catch-up ball, if you will, because you started too low. And that's the risk that we could avoid. No one wants to set margins that are at levels that are punitively high. No one wants to try and make it uneconomic to trade financial futures. But what we have suggested is that it would be possible, and Jerry Corrigan has suggested 15%. I had suggested 20%, but would be happy at the 15%, to set some level of floor so that we're not trying to carry 98% leverage in a $20 billion market. That just creates a little too much risk that we don't need to carry.
What happens if you set a 20? Do you want to comment on that? And were there any restraints in the trading that occurred on October 13th? People have trouble making the margin call?
Absolutely not. And let me just clarify for the record, margins are not set based on an average day's move. Basically, the way they are set for prudential purposes at the exchange level is to cover 95 to 99% of all moves over the preceding 6 months. And so it's not just an average day's market move that would be covered. Chairman Breeden suggests that the additional margin that was collected on October 13th and then on October 16th created a liquidity problem and potential need to sell off futures positions to make the margin calls, and there's no evidence of any problem in collecting those margins. They were increased $1,000 a contract on October 13th, phased in another $1,000 a contract on October 16th, and I would just raise a question in terms of consistency of setting margins. The SEC does have the authority over the margins on the OCC and the CBOE. And if the SEC had extreme concerns over the margins of the S&P 500 futures, then I question whether or not they shouldn't have looked at their own market over which they do have margin authority and caused them to increase the margins when they felt the margins were low early that summer. In fact, the margins on the OCC and the Chicago Board Options Exchange, which are under the SEC control, have pretty much marched in sync with the S&P 500 futures margins. So I really have a question about where the inconsistencies are. If there are concerns over inconsistencies in futures margins and stock margins, why isn't there concern about inconsistencies between options margins on the exchanges that the SEC regulates and stock margins? In fact, and as we've said many times before, that the margin collections were made. There were no financial problems either on October of 1989, and in fact, as far as financial integrity of the futures markets in 1987, they fared much better than corresponding derivative markets, for example, overseen by the SEC.
On volatile days in the stock market, it's my understanding that the procedures of the New York Stock Exchange make it very difficult to keep up with the volume of trade, and that the futures, the sale of futures, gives in a way an ability to keep up with the market or to get ahead of the market. I know that I read in The Economist that the futures market was thought to limit the downward plunge of the Japanese stock market, so they apparently reached a different conclusion there with respect to futures trading than here. But am I mistaken that the stock exchange has more difficulty? I believe the stock exchange, New York Stock Exchange, has more difficulty in absorbing the very large volumes on these very volatile days, and that they are helped by the presence of the futures index and the ability to trade those. Yes.
Senator, I would want to make very clear that we think the financial futures markets and the stock index market in particular, futures market in particular, are extremely valuable to the overall capital markets. I've said in my written testimony, I'm happy to say it orally, there's no question that the ability to hedge in those markets is a great benefit to many investors in the stock market. So there's absolutely no question of anybody at this table suggesting that they're not valuable. In the margin debate that you are raising, it is a question of whether the government should have any role in overseeing these practices, and we think it should.
Let me ask the question again because you seem to have missed it. On days when there is a very large amount of trading and a great deal of volatility, I am told that the stock exchange, the New York Stock Exchange, has difficulty in keeping up, and that they are in fact aided by the abilities to trade these future contracts, so that perhaps and some of the horseshoes or some of these things were closed down on the particularly volatile days. Am I correct in that the futures, the sales of futures can operate more quickly and therefore more quickly establish a base?
You've asked several different things. You are not correct that the stock market has worse trouble processing transactions. That was something that happened in '87. Actually, both New York and Chicago had some trouble. The New York Stock Exchange found its order reporting systems, computer capacity, very severely strained, and it took 6 hours for some of the margin payments to be made in the Chicago Mercantile Exchange. By '89, both exchanges had invested considerable amounts in their computer processing capabilities, and I think both exchanges, the New York and the Merc, do an excellent job of processing customer flow.
Would you comment on that, Chairman Graham?
I think what you're referring to is the fact that in a rapidly moving markets, that it can be more efficient to move into the futures markets, take a position temporarily on the futures and stock index futures, and then go back to the stock market and make those transactions in a more at a slower pace, and that I think is a tool that's used by a large number of institutions.
Thank you. Pardon me for interrupting you, but thank you, Mr. Chairman. And I would say again that I trust that there won't be a turf battle that's going to in any way impose itself on markets or to injure markets. I would say to the witnesses that it is absolutely essential that that not occur, and that these markets need to be protected, that they're vital to our economic well-being. And in the event such a fight were to start, there are lots of folks in London and Tokyo who would love to have a larger share. Thank you, Mr. Chairman.
Thank you very much, Senator Bosford. Senator Bond.
Mr. Chairman, since I have the distinct pleasure of serving on the Banking Committee, I will assure you and the witnesses that the testimony is just as exciting and thrilling and complex as it was before the Banking Committee.
No, it was more interesting, I thought, before the Banking Committee. You think back, if you wish, to who testified there. I just mentioned that. You still have a few amendments to come up in the Farm Bill.
Mr. Chairman, we're never at a loss to hear your views, and we always welcome them in this forum as well. So I'm sure we'll have an opportunity to do that. All that was by way of preface.
For all that, we can take all that part out of the record before anybody actually struggles through and reads all this later on. But Kit, go ahead.
At this point in the hearing, Representative Bond's microphone malfunctions. We'll resume the coverage of this hearing at a time about 15 minutes later, with Representative Bond's final question.
why can't the SEC and CFTC work together like various police agencies, local, state police agencies, FBI? These agencies have to work together frequently. Why wouldn't the same kind of thing work here? And do you know of any instance where the SEC and CFTC have not worked together?
Well, I think they can, and I believe they do work together. I think the issue is what is the most efficient regulatory system, enforcement system. And I think there are some just clear inefficiencies in having two regulators trying to deal in what is effectively trading in one market. We may define it as two because the marketplaces are separate, but the trades and the way the participants approach it is that it's one market, and that just is going to lead to regulatory overlap and lack of effective cooperation in some cases. I don't know enough of the specific experience of the SEC and the CFTC to document those cases for you, but it is striking that there's much more enforcement activity in the individual marketplaces than across those marketplaces. And I think there's something to be learned from that.
The two agencies work closely together. We need to. That's something that we have always tried to do, and I think at the staff levels, both agencies are comprised of highly dedicated professionals who I think are among the greatest resources of this government in trying to deal with an extremely dynamic, extremely complex system and to protect the public interest. We go to bed every night with $3 trillion of the American public's money invested in our markets. That is, in a very real sense, people's pensions, their futures. And we care, and our agency and staff care very deeply about making sure that we have the safest possible system to protect the 50 million Americans whose money that is. I know the CFTC feels the same way about protecting the stability of their market and protecting against threats and interruptions to it. And in the course of dealing, since stocks, options, and index futures are in fact one market, and there's really not any economic difference between the S&P 500 stocks bought individually and the S&P 500 stocks wrapped up in cellophane bought in a futures contract, our two staffs have to work together because we're both regulating what in that one area is the same thing. And, but the problem is, and our suggestion is, that the system would work better if on critical issues where after you've heard all the comment and you've heard all the debate and ultimately a decision has to be reached. In every other foreign market, there's one decision maker, and in the U.S., there's two. And we think a system in which at the end of the day, when the buck stops somewhere, that we get one answer and not two to the problems that confront what is a single marketplace.
First of all, there hasn't been a problem that's been identified in terms of having the SEC and CFTC staff work together on enforcement issues, particularly on intermarket fraud. They have worked well together not only in this area, but also in other areas, in other fraud areas where we've shared information. We work cooperatively with regulators and enforcement officials at all levels. There is no reason in theory or in practice for a jurisdictional change to improve that situation. I would liken the intermarket front-running situation very much to the audit trail. As you recall, one of the early reasons for an audit trail was to be able to detect and deter front-running, and that required having the data to be able to sequence the data to see if someone was taking a position ahead of his customers. What is happening with respect to intermarket front-running is that the data systems and the sharing of intermarket data, which has to occur at the exchange level, is indeed occurring, and there's now more routine sharing of information that is ongoing under separate regulatory structures between the CME and the New York Stock Exchange that will help us begin the process of determining whether or not intermarket front running is a problem, the extent to which it's a problem, and to bring violators of those laws and regulations to justice. And that is something that's just started at this point in time. The CBOE is not part of that information sharing program. And the CBOE and the New York Stock Exchange are under one regulator. In fact, the CBOE is the one major exchange that doesn't have a definition in place of front running that would include futures markets that is consistent with the New York Stock Exchange's definition. So my question is really, I don't see a problem here that a jurisdictional fix would address. And I would also like to add, just to put some information into the record with respect to the characterization of regulators, international regulators around the world, that it is not quite as simple, the structures are not quite as simple as Chairman Breeden has suggested, and I will enter for the record just more detailed description of some of the major international regulatory schemes.
I appreciate that, Chairman Graham. I had this sneaking suspicion that
Was that a
Chairman
signal?
is ready to call the end of my
It is,
questioning.
but we will have another go-around, and I'll yield to Senator Heffley.
Thank you.
Chairman Breeden, in another committee, there's a lot of spotlight on the American Continental Corporation, Lincoln Savings and Loan, and Charles Keating. An article appeared in Barron's of April the 16th, 1990, entitled, "What Investors Never Knew. Ugly Facts About Charles Keating Were Not Disclosed," by Benjamin J. Stein. Seen this up?
I don't recall it in detail. I may have seen it at the time. I know he's written several diatribes in Barron's on various subjects, and I'm not sure which species this particular article is.
Well, it's recent, and I don't know whether anything is true or not. It just do it, but he makes rather drastic charges about the SEC in this article. Without going into it in detail, I'd just point out the fact that Keating and the American Continental Corporation and these others had charges brought by the Securities Exchange Commission over a period of time, and that in various instances when there were prospectus that it wasn't in it, and that no charges were made. I just read a little bit here. It says the Securities Exchange Commission complaint noted the extraordinary nature of these transactions had not been revealed in the AFC's filings, and rather they had been described in normal loan transactions. In other words, SEC alleged that Keating and Linda had been using the funds of a federally insured bank they controlled to make risky loans to help them sell an asset of the company. And it goes on and says in 1986 and 87, the ACC filed with the Securities Exchange Commission for the sale of 25 million of debentures, as well as a sale of another 25 million, and filed registration statements for 200 million of various things. He makes rather severe charges. He says that the investors were sold over $200 million of debt instruments that were now worthless and traded in about 30 million of equity issues which are now worthless, without the Securities Exchange Commission requiring that they be told the most basic facts already in the SEC's hands about the insurer. To this day, the SEC has still not issued a complaint about any Keating, Lincoln omission or lie at all. He then goes on, and this is rather drastic, there is no security law without the enforcement of the security law. Yet in the case of ACC and every other case that I've studied, the SEC simply does not enforce the law on the books. This fools investors, makes them think that they are protected when they're not, makes life much easier for crooks. In a word, the kind of failure at law enforcement one sees in ACC and Keating means that there is a real question as to whether investors can count on minimal federal law protection. Now, I'm not saying anything is correct to this, but it's a rather drastic charge of dealing with an issue that is certainly in the spotlight today. If you're not familiar with it, I would ask you to, I want to give you an opportunity to reply to it, look at the article, and if you would, reply in writing in regards to the answer of it, if you would.
I'd be happy to, Senator, but let me, if I could, just respond in brief and to some of the charges as you read them. You have me somewhat at a disadvantage because, as you may know, we have an open investigation of this matter, and I cannot discuss certain items of that investigation without fear of prejudicing the case against the subjects of that investigation, which I don't wish to do.
Well, I don't want you to do anything like that.
But the notion that the Securities and Exchange Commission doesn't enforce the securities laws is patently absurd. We have collected over $1.3 billion in fines and restitution for defrauded investors in the Boesky, Levine, Drexel, Milken cases, and I think the record of the Enforcement Division of the Commission in being vigilant and highly effective in rooting out fraud and corruption in the securities markets is outstanding. And with all due deference to Mr. Stein, and he is entitled to his views, I will say that the SEC has a record second to no agency in this government in enforcing the laws, and I certainly hope to see that it stays that way.
All right, so this is some concern in regards to it. Let me ask you, what studies have been conducted to evaluate the cost of the impact upon the U.S. futures market of duplicate regulations by two federal regulators? Have y'all made any study of the evaluation of the cost impact on futures markets in that regard?
Is that?
Yes, sir.
We, obviously, it's impossible to do a precise calculation because you'd have to see what the specific terms of the law was. It would make a big difference if you were regulating futures products as securities or whether you were regulating them under the CEA. We think, long run, that the proposals can save enormous amounts of money for the participants in these markets. The major firms trade stocks, options, and futures. It's a single market, and they're in all aspects of it. And they're today forced to keep two separate sets of compliance systems, two separate sets of registering and testing personnel, duplicate everything, one for the SEC and one for the CFTC. And we think that there's a potential for enormous savings for the users of these markets by eliminating a lot of that duplication.
In the 1987 market break, the option exchanges regulated by the SEC experienced difficulty in opening and reopening their markets and maintaining sufficient liquidity. You probably have made some changes pertaining to that, but on contrast, the futures market were relatively unaffected by the market crash. Given the SEC's track record with one derivative market, what confidence should we have that similar problems could not occur if the FEC regulated the stock index futures?
Oh, I think you could have very great confidence, as you point out, happily, as I appreciate you doing so. The SEC has been regulating derivative instruments for 50 years. We have a substantial amount of experience. our Market Regulation Division has substantial expertise in this area. So I think we have a long-standing track record. I think it's a very good one. There were other types of problems in the stock index futures markets, both in '87 and '89. There was a 6-hour delay in meeting payments from the clearing agencies in well over $1 billion. There were enormous liquidity problems. The imputed price of the Dow, according to the S&P, if you valued the S&P 500 market, the imputed price of the Dow would have fallen to as low as 1,400 in the October market break, whereas in fact the market did not fall that far. The imputed price of the Dow, if you took the liquidity of the futures market as a measure, last October would have been a fall of 250 points. Dow actually only fell to 190 points. So there's, and Secretary Brady, and I may be better to defer to Secretary Glauber here in part answering that, but I think the problems of the illusion of liquidity in the futures markets that disappears in a flash when there's a stress on the market has been extensively documented by the Brady Commission and others, and is one of the principal reasons why we feel, just as a matter of prudence and safety and soundness, that there are some improvements that need to be made in the system.
I believe my time's up.
I want to return to Senator Heflin's last question because I didn't understand your answer. He asked that the options market that the SEC oversees was halted or was sufficiently, not sufficiently, but rather impaired by this by the volatility of the market, and yet the futures market wasn't. Would you, why should we feel some confidence that the SEC is going to be able to handle such volatility in the future when it apparently hasn't done as well as the CFTC has done in the instances that you seem to cite as evidence for the SEC to take over the whole thing? Chairman Breeden.
Senator, I'm going to say again, and I'm going to keep saying it, that we have not suggested that the CFTC in any respect has done a bad job.
It apparently failed to do with the options market when the markets were volatile. Answer the Senator's question. Senator Heflin's question.
I tried to answer the Senator's question to say that there were problems, very substantial problems in both markets. Those problems were of different types. There certainly were problems in the options market. There have been enormous changes made since then, as there were problems in the futures markets, and there have been changes made since then. So I don't see the connection between the fact that there were problems in both markets, and I'm not going to sit here and argue that our markets are perfect and that a 500-point drop in the Dow doesn't put the whole system under enormous pressure. It does, and it's that very pressure that causes us to want to try and strengthen the girders that hold up this bridge that trillions of dollars of the public's market money is invested in.
May I just have one or two more. I would say again to both chairmen, you spoke about, you, Chairman Breeden, about the fact that the markets were extremely dynamic. Then you used the term extremely complicated, and that we needed the safest possible system, that 50 million Americans, because of the pension trusts, so forth, that we're relying upon this system, and that at the staff level, you said, and quote, our two staffs have to work together. And then Chairman Graham said that there hasn't been any area identified where the staffs had not worked together well. I just to say to you that my fear is that when I see turf battles occurring in Washington, sometimes there's not a continuation of this good working relationship. And I trust that both of you will go back, and I make the point, as you see for the third time, both of you go back to make sure that the system does remain the safest possible system, that we have a recognition that it's extremely dynamic and extremely complicated, that we know that it's not only you two who must interact, but that your staffs must interact, and I hope that you will see to it that in the interaction of the two staffs, that they continue to work in the same smooth operations that have occurred in the past, and that this hearing or other hearings or turf battles do not in any way encumber that. Thank you, Mr. Chairman.
Thank you. Let me, I have about an hour to an hour and a half's worth more questions, but I will submit most of them for the record. Let me, and I say it seriously, I would ask each of you who have questions for the record to try to return the answers as quickly as possible, because I was very serious in what I said earlier, that I intend to join with the distinguished senior senator from Indiana, Senator Lugar, and make every effort to get this bill on the floor under a tight time agreement. And really the questions every senator has asked here today, and the ones Senator Lugar and I have asked, are in anticipation of what kind of a debate we might have. I mention that because the basic question we'd asked Secretary Glauber, that took about 7 weeks, and I understand, and I realize, and please don't take that as any kind of a personal criticism. It's not. I know the kind of interagency debate and the kind of debate that went on within the administration, because the innocuous question that Senator Lugar and I asked was not, and I realize that. But please answer these as quickly as you can, because it will, if we can get agreement to bring it on the floor. I'd like to look, Chairman Graham, at some of the impact on the CFTC, because I think in many ways you have been there where everybody who's testified here has praised you, that they're in favor of your confirmation and everything else. And I think of my favorite course in college, which was Shakespeare, and one of my favorite plays was Julius Caesar, and I hope you don't feel like the funeral scene in Julius Caesar, because I think they do tend to praise you. Not necessarily.
I feel the same way myself.
Not necessarily to bury you, but last week Jim Stone, who used to be the CFTC chairman and was one of the first ones that I recall after I was on the committee with oversight in this area, he opposes stock index futures generally. Just I'm trying to be as fair in setting his position as I can for former Chairman Stone. He opposes the stock index futures as a general proposition. He also supports merging CFTC and SEC. With that on the table, he said this about stripping the CFTC of jurisdiction for stock index futures. And when that issue was raised to him, he said, quote, "This is an unappealing prospect which would leave the CFTC a stepchild agency. The CFTC is underfunded and underappreciated in its current configuration. And matters would be worse if it were so wounded," close quote. Now, that same concern that the CFTC would be badly weakened by jurisdiction transfer appears to be widely shared by the agricultural community, at least in the kind of letters that I have received. So, Dr. Graham, you're sort of the cop on the beat for the futures markets. Do you agree with Jim Stone's assessment? In other words, if you lost jurisdiction for stock index futures, would it make it more difficult for the CFTC to do its job of policing the other futures markets that would remain in its jurisdiction, police them against fraud and abuse and manipulation, all the things we want you to do?
I strongly agree, and that view is also held by a number of the agricultural community, because we regulate and monitor and bring cases against futures transactions, and we regulate the whole exchange. So we have a small staff, but that staff monitors all futures markets in the same way. If we were to lose some of that staff, in order for the SEC to create a mini CFTC within the SEC, then our staff would be severely hurt. We're very small, so even if our staff may, even if stock index futures volume may be a small percentage of the volume that we monitor, we have people who monitor not only stock index futures, but all financials, soybeans, and wheat, cattle in the same way. And that's the expertise that we would lose, and it would hamper our ability to monitor those markets.
Well, let me go there, and I will go to Chairman Breeden about it. You talk about the transfer and what SEC would have to do, and I would assume that if you had this SEC branch for stock index futures, if that was transferred over there, it would have to conduct, obviously, active oversight on the exchanges. I don't think anybody disagrees with that. It would have to oversee an expanded registration system. It would have to bring, or help to bring enforcement cases. They have to police against floor abuses. They have to monitor margins, write regulations, and so on. So what I'd like to do, Chairman Breeden, to get a kind of a sense of the level of the money and the staff that you'd be willing to commit to this purpose, assuming stock index futures were transferred to the SEC. How large a branch would you propose to create inside the SEC to regulate stock index futures?
Well, sir, that would in part depend on the scope of the assignment we had and the way the law was written. And I'm not trying to be evasive, because it would take far fewer people if we were regulating these products as securities under the 34 Act. It would take more people if we were going to do what I suggested we would prefer doing. It would take a few more people, but would be less difficult on those exchanges to regulate them under the CEA as they now are.
Well, let's take Let's take your druthers. Let's say it was done the latter way. What do you think it would take in staff level and the budget? And I realize it's a ballpark figure, but I mean, you must be thinking about it. After all, you and the Treasury and others have suggested this shift, and so give me some idea.
Well, we would, of course, long before it actually happened, hope to consult closely with the CFTC, find out how many people are currently doing so. But if you took a ballpark number of somewhere in the nature of, say, 100 additional personnel, which would be about 1/3 of our existing market regulation division, and that's certainly a level of resources, particularly if Congress would let us keep part of our $80 million surplus that we will be generating this year. We could easily absorb and fund. One of the benefits, frankly, that we have is with a much larger agency having some flexibility. We already have a regional office with 100+ people in Chicago, and in all the other locations, most of the other locations, the CFTC offices are located. So we think that we could use the existing resources and systems of the agency without an enormous number of additional personnel.
And I agree that you do have certain economies of scale, but that what you say is not enormous addition is about 20% of what the CFTC now has for their whole operation. I mention that because it goes to the overall idea of where we are, having lowballed the CFTC all these years, and just where it now stands. Let me ask you this again, Chairman Breeden, and please, Mr. Secretary and Dr. Graham, feel free to jump in on any of this you'd like. I don't want Chairman Breeden to feel that he's somehow being singled out, because nobody here would want to do that. Well, assuming the stock index futures were transferred to the SEC, whom would you allow to sell stock index futures contracts to the retail public? And I see three possibilities, and tell me if there's others I've missed. One would be brokerage firms that are now registered under the commodity law as, I believe they're called futures commissions merchants. Secondly, firms registered under securities laws as broker-dealers, or both?
Well, today it's usually, it already is both. Merrill Lynch, Shearson, Bear Stearns, all the major securities firms are also active participants in the futures markets, and they're registered under both. Now, the same individuals are not always registered under both systems, but the firms have personnel that are operating in all of these markets, and as I said earlier, that requires those firms to keep a duplicative system, which we would love to move in the direction of having single registration, or at least cross-recognition of personnel, so that whether the original registration was as an FCM or as a broker-dealer, that long run the objective ought to be to have the personnel able to give advice to customers on stocks, options, and futures, because there are investment trade-offs, very direct ones, between those futures.
Would you preclude either one? Would you preclude an FCM or a broker-dealer?
Preclude them from operating in the other market?
Preclude them from selling stock index futures contracts.
Well, under the assumption that the law was passed the way we've suggested, the only people who would be allowed to sell stock index futures would be people who were registered under the Commodity Exchange Act. That would be all the current people who are so registered. Many of the broker-dealer firms have, in fact, personnel under that system. That would continue. Down the road, we would like to see a system in which it were possible for people registered under either system to operate in these closely linked products.
Secretary Glauber.
I'm just going to point out, Mr. Chairman, to the extent that happened, that would open up a vast new sales force to attract customers to deal in these products. And I think the same thing could happen at the institutional level as well. Some institutions which have traditionally just not dealt in the futures market that are more at home in dealing in the stock market might, under these conditions, also deal much more in the futures market. I think it could indeed increase volume.
I'm glad to hear that, because during the discussion over the IPS issue, one of the reasons why the Philadelphia Stock Exchange, the main reason why the Philadelphia Stock Exchange proposed the IPS product, is they wanted to have a futures type product that they could sell to the retail customer. And my response was that then why don't we do a cross-registration of professionals whereby this IPS products could be traded legally as a futures on the Philadelphia Board of Trade, which is a subsidiary and a future subsidiary of the Philadelphia Stock Exchange, and then allow that IPS product, which would be legally selling under the futures regulations, let that IPS product then be sold by the retail network of the securities industry. That is currently allowable under the current laws, and it's a proposal that I raised with the SEC staff before the litigation occurred, and it was raised again once the Seventh Circuit came down with a decision saying that the IPS products are futures. And it was a proposal that was made so that these products could be allowed to trade and would not have to be liquidated, and that was rejected by the SEC. So I'm interested in hearing that. I think that's something that could be undertaken at this point in time without a change in the law, without a change in jurisdiction, just sitting down and discussing.
That obviously, we could have a long discussion about the IPS product. I was trying to respond to your question about registration. I would very strongly disagree with the characterization of Chairman Graham that the suggestion of making people trade new products as futures rather than giving them the option to trade them on whichever market they want to trade them, securities or futures, would solve the problem that had been involved in the IPS case.
But the issue is whether or not securities registered professionals could sell futures products, and that's a regulatory issue that just coordination could solve and would not take a change in the law itself.
The bigger
point,
I think, is that, as Secretary Brady has emphasized again and again, and which lies at the heart of the decision of the Bush administration to propose this legislation, the stocks, options, and stock index futures are one market. The S&P 500, whether you buy them directly on the New York Stock Exchange or whether you buy them through a futures contract on the Chicago Mercantile Exchange, you are dealing with the same economic entity. And the same firms, by and large, reflect that. They're in all of these markets.
They're what?
And they are in all of these markets. They have professionals who are trading at any given moment in time, stocks, options, and futures. In every other country with which we compete, there are much more closely unified systems. While there are different SROs and there are some different technicalities, in all the other countries, at the top of the decision chain is an agency, a single agency, that can resolve differences to try and make the job of competing in this single market the most efficient possible. And we think that that change would be an improvement.
Of course, some have argued that the fact that there isn't a single agency doing it, that in itself has brought about some of the innovation, the fact that there's been more competition and innovation. I realize you can get arguments both ways on it, but I just didn't want the record not to note that. Chairman Breeden, I didn't...
Yes, sir. I agree that that's why I, with all due respect to Senator Boschwitz, when in trying to paint this as a turf question, I think reasonable people can differ. There are reasons why some people, as Chairman Greenspan tried to indicate, prefer a market in which there are multiplicity of regulators, a large number of regulators, and there are other good reasons why some people would choose to have somewhat fewer regulators. And I think what's involved is a serious issue of the organization and the structure of the regulatory system and how best to achieve a balance of two factors: competition, which is vital to our market, and also safety and stability, which is also vital. And we've seen what happens when either one of those factors is not paid careful enough attention to. But reasonable people can differ on how to structure that. We support the administration's views that a change would help improve the system, and we fully respect all those who disagree with that proposition.
Thank you. Anybody else?
Senator Leahy, there were a number of issues that were raised earlier on in this whole discussion, and if you would permit me just to enter some other information into the record, because I do believe that some of these issues should not be left open. First of all, I take exception to Undersecretary Glauber's characterization of the agriculture community's views on the jurisdictional issue, and I think that probably all of us would be loath to characterize their views on anything, but they have spoken for themselves. I want to put into the record not only the letter from the Farm Bureau, but also the letter signed by some 18 agricultural organizations that oppose transferring of jurisdiction and the concerns that they raise about the impact on the agency. I also take issue with the point that we've been distracted from our regulatory responsibilities. I think more, in all due respect to our hardworking staff, probably what's been neglected are their family responsibilities. But at any rate, we have been promulgating an enormous number of rules and reform regulations as we feel are necessary. I do, and Undersecretary Glauber, I have been the one that's been most aggressive with respect to making sure that the working group keeps addressing the issue of coordinated circuit breakers, as you well know. Third area is the area of clearing and settlement. I'm quite concerned that we have a new version of what happened in 1987 in the stock market break, not only about what actually happened, not only in the New York Stock Exchange and the options exchanges, but also with respect to clearing and settlement. Let me just summarize some comments. The Brady Commission found that, quote, a substantial number of New York Stock Exchange specialists appear not to have been a significant force in counterbalancing market trends. There were many opening prices that were set by specialists that were grossly inaccurate. Market-making performance had deteriorated in the over-the-counter market, et cetera, et cetera. With respect to clearing and settlement, that I'd like to enter just some information into the record, that for the futures markets, the performance in clearing and settlement was far exceeded the securities markets, that all clearing members were paid within the legal time frame. It is true, and there were total of 90 clearing members that were paid. It is true that there were 2 of these 90 clearing members who received payment that were later than normal for an administrative reason, but they were still within the legal time frame. And the reason why they were later than normal was that the settlement banks had not received accurate instruction sheets at the usual hour with respect to intraday variation payments, and that has since been cleared up. The fact that claims that clearance and settlement processes would be better regulated and coordinated by a single regulator are refuted by the October 87 experience. That, in fact, under the OCC, all clearing members on that date received late payments, and on the NSCC, which is the National Securities Clearing Corporations, 3 clearing members defaulted or had to withdraw as their depository membership. So I think that let's look at the record again and review some of the studies, including the Brady Commission study, as to the performance of these markets in October. I think it is common knowledge among international futures and securities regulators that the future-style clearing and settlement system is far superior to that of the securities side. With respect to the stock market decline that Secretary Glauber mentioned, the 6% decline, there are at least 13 other days where the stock market declined more than 6% since 1930. And as usual, it's difficult to relate such drops to news events. And finally, with respect to foreign regulators setting futures margins, in fact, in all countries, the futures margins are set at the exchange level. And while there might be some oversight, it's very limited. And as you know, we have limited oversight in the setting of futures markets. And the Japanese it was the Japanese embassy official related to me that even in Japan, they do not have regulatory day-to-day oversight of futures margins in the stock index futures in Japan. All right. So I'd like to include that in the record. And finally, for Senator Boschwitz, on jurisdictional fights, we didn't pick this jurisdictional fight. It has occurred in the past, and we feel a little like the younger brother who every once in a while gets punched out by the older brother and then stands back and says, this violence must stop. We did not pick this jurisdictional fight, and I agree that I'd like it to end as well.
Thank you. I will keep the record open to the end of the week if anybody wishes to add something further, or if at 3 o'clock tomorrow morning, if you wake up and think of something you should have said, don't call me. The record will be open. I hate being one of the few senators with a listed home phone number. I always worry about that, but don't call.
Senator Leahy, if I could just real quick interjection so I don't have to call you. I'm appreciating the sentiments Chairman Graham expressed of how they feel and the younger brother, and I sometimes feel like the kids who have to go through the debate saying, my daddy's smarter than your daddy. And I think there is an element sometimes of these are competitive systems. There are rivalries out there in the marketplace. Some of those rivalries do get reflected in our agencies, but I know that it's Chairman Graham's intention and my own and Secretary Brady's that we try and focus on doing the best job we can for both markets, produce the strongest possible system, the best job for the public. That's who sends us here, and that's who ultimately we have to be accountable to.
Mr. Chairman, without extending needlessly a already long
All
hearing.
the time you want. You've been very patient.
Thank you, sir. Just a couple of brief points. First, let me confirm that Chairman Graham has been a very active participant in the working group, and indeed on the particular issue of circuit breakers has brought that issue back to us. We've met at the staff level once, and we'll meet at the principals level in the near future. On the issue of the amount of the money that was late arriving from the clearinghouses, it was later than normal. It was about 6 hours later than normal. It was $1.5 billion. It was a disconcerting amount of money. We viewed it, when we studied it in 1987, as bringing us very close to the edge. And finally, on the statement I made in my written testimony that on the number of down days prior to 1982, I believe the numbers in that testimony are correct, but in any case, it's something we can settle because it's factual.
Well, I thank you all, and also Chairman Greenspan. I think you have been all of you very patient. I appreciate your responses and the